Welcome to the March 3rd public session for the Private Company Council. I'd like to welcome Wim Schaefer, who's joining us for his first official meeting, as well as Mark Baer, who's joining as our FAF liaison. Thank you both for calling in and everyone out there watching. This is a virtual meeting, and I will remind the Private Company Council it's much more difficult to participate virtually, so make sure that you get engaged early and often. Looking forward to hearing the discussions today. Later this month, the FAF will be issuing a formal call for nominations to fill Robert and Doug's roles on the Private Company Council as they're ending their 6-year total terms in December. So look for that. And if you haven't already applied, there's an evergreen application available on the PCC's website. Please take time to find people you think would be interested and good to join us. And so with that, I'll turn it over to Jennifer Weiss, and we'll talk about our town hall liaison meetings.
Good morning, everyone. So since the December PCC meeting, there have been 3 PCC liaison meetings, and Adriana and Ashley are going to highlight some of the feedback that we received.
Thank you, Jennifer. In January, PCC members, a FASB board member, and FASB staff met with members of the Institute of Management Accountants Small Business Shared Interest Group to discuss PCC research projects and other topics. And for ease of reference, I'm going to refer to them as the IMA. IMA members' feedback on PCC research project is covered in the research project memos that you're going to be discussing later today. So now I'm only going to walk through their feedback on the other topics discussed at that meeting. And those relate to technology and financial reporting trends affecting private companies. On the topic of technology, IMA members expressed caution about the current impact of AI on financial reporting. Many noted that existing AI tools can produce inconsistent results and still require significant manual oversight. IMA members noted smaller private companies in particular face cost and resource constraints and cautioned against assuming that technology automatically improves reporting efficiency. IMA members noted some companies have successfully leveraged technology and AI in the sales function and related financial reporting, and others are prioritizing broader system upgrades, such as ERP implementations to support growth rather than focusing specifically on the use of AI in financial reporting. IMA members encouraged the PCC and FASB to share stakeholder insights on effective technology use, incorporate clearer definitions and accounting standards to facilitate automation, and provide guidance that supports a practical technology integration. On the topic of financial reporting trends affecting private companies, IMA members noted that ongoing supply chain disruptions, labor shortages, rising costs, wage inflation, and tariffs continue to pressure small private companies and add complexity to financial reporting. IMA members also noted that in line with an overall aging population, there are more aging small business owners increasingly selling their businesses, resulting in those companies having to navigate complex accounting and tax considerations associated with those transactions. IMA members encourage the PCC and FASB to remain mindful of small private company resource constraints when developing new standards. They cautioned against expanding disclosure requirements based on assumptions about widespread technological capabilities, noting that the cost and complexity of implementing new standards and the impact on related systems. IMA members emphasized the importance of focusing on information most relevant to typical users of private company financial statements, and also emphasized drafting standards in clear, plain English to enhance understandability and practical application. Now I'll pass it over to Ashley to discuss the CFMA liaison meeting.
Thanks, Adriana. The February Construction Financial Management Association, or CFMA, Emerging Issues Committee meeting was a continuation of the November meeting. We had such a robust discussion in November that we didn't get to all the topics on the agenda. So the topics discussed in February were all topics identified and led by CFMA and included joint ventures, emerging issues, including tariffs and ESOPs, and subsequent events. On joint ventures, members noted that these arrangements are becoming more and more common and complex in the construction industry. One member noted, with these arrangements, an entity must first work through the VIE guidance, which can be burdensome, and suggested that it could be helpful to private company contractors if there were a way to get to a quicker conclusion on the accounting for joint ventures without going through that analysis. Members also noted that joint ventures are generally not used as investment vehicles, but rather to complete normal business operations on large projects. They noted that there is some diversity in practice in the application of the equity method and proportionate consolidation guidance and the use of a hybrid presentation. That is a one-line item equity method investment on the balance sheet and a gross proportional income statement. On emerging issues, CFMA members first discussed tariffs. They observed that there aren't any current financial reporting or standard setting considerations related to tariffs, aside from whether there should be any disclosure requirements regarding the effects of tariffs. But they did acknowledge that those could fall within other disclosure requirements around commitments and contingencies or risks and uncertainties. Members also discussed ESOP accounting, but I will leave that for our next topic. And lastly, on subsequent events, members noted that while the guidance is not difficult to understand, there is some diversity in practice in applying the guidance, particularly around changes to contracts.
Now in February, PCC members, FASB board member and staff met with representatives from the Surety and Fidelity Association of America, SFAA, and representatives from the National Association of Surety Bond Producers, NASBA, to discuss PCC research projects and other topics. And as I noted before, this will only cover the other topics because you'll be talking about the research projects in subsequent sessions. With regards to the effects of technology on financial reporting and standard setting, surety industry representatives noted that they're increasingly leveraging technology and AI to improve efficiency, but the effectiveness of these tools depends on high quality, consistent financial reporting. They emphasize that the notes to the financial statements remain essential to user analysis and are unlikely to diminish in importance as technology evolves. They also highlighted the need for greater standardization in financial reporting to better support automation and data analytics, noting that XBRL has advanced standardization and resulted in more efficient analysis by financial statement users. With regards to contract assets and contract liabilities, the SFAA representatives reiterated that they still want more transparent information about retainage amounts, specifically a mandatory presentation that grosses up contract assets and contract liabilities on the balance sheet, or at a minimum, required disclosure of that information. With regards to reporting trends, surety industry representatives noted that financial statement preparation and compliance costs have significantly increased for their clients and asked the PCC and the FASB to be mindful of these cost increases and to reduce costs whenever possible.
Great. We can move on to the next slide and then we'll pause for questions and comments from PCC members. So looking ahead, the PCC forum at the AICPA Engage Conference is scheduled for June 9th. This forum is intended to be highly interactive with conference attendees, so it's a great opportunity for private company stakeholders to provide the PCC with input on private company financial reporting issues. In September, the PCC will have their annual in-person liaison meeting with the AICPA's Technical Issues Committee, and there will certainly be other liaison meetings that will be planned throughout the year. On May 4th, the FASB will host a webcast focusing on private companies and not-for-profit organizations. Jerry will present on the webcast along with representatives from the FASB. Q1 2026 is off to a great start in terms of articles and interviews. Articles have been published by the NASBP and the California State CPA Society. The Texas State CPA Society should be publishing an article in the next couple of weeks, and we're working with other state societies to publish some other upcoming articles. And tomorrow, Jerry will be interviewed by Accounting Today. So with that, I will pause for questions and comments.
Thanks, Jen. And one additional comment. In the next 2 to 3 weeks, we'll be issuing our second annual report for the Private Company Council. And in there's information about all the members, as well as how you can reach out and connect with us about issues that are pertinent to you. So look forward to that coming out. Any other comments from any PCC members on any of the liaison participation you've had so far? Dave Pesch?
Yeah, just want to mention again that there was some subsequent conversation with the Surety and Fidelity Association on communications with them, and they felt like we didn't reach out, although we did attempt to try, and they did not respond. But going forward, I think we're going to try and do a little bit better job with them and direct them also to help themselves a bit by using the action alerts, so they can sign up for those and know a little bit more about where things stand. But very good subsequent conversation with them. Also on the CFMA comment on joint ventures, they are becoming more prevalent. It's primarily because the job sizes are increasing substantially, and bonding capacity becomes an issue for someone to be able to bid a project when they combine one or more scopes of work, like say for a terminal building, plus all the groundwork at a new airport building. So they are finding it a bit more common, and thus the cost is going up. So their comment there is really it's actually founded in what we're seeing in the surety industry on the number of joint ventures that are being submitted on a weekly basis.
Thanks for that, Dave. And this just reinforces that we do learn a lot when constituencies connect with us. And so if you're a lead of some sort of industry group that has relevance on emerging technical issues, feel free to reach out, and we'll see how we might be to collaborate and learning what you and your industry members are thinking about issues. Fred?
Just to follow up, Dave. Dave, you talked about the expansion of joint ventures. Are these joint ventures that qualify for joint venture accounting, or are these simply joint ventures in a more generic structure?
No, they typically will require joint venture accounting. Most of the time, you're either going to do a contractual joint venture agreement. At times, you'll form an LLC between the two entities, but it's more common just to see a contractual underlying joint venture agreement separating out the roles and responsibilities. So you do have to take a deep look into it. Also, the users, like the sureties, we want disclosure on joint ventures. We believe, I will say this, I believe the disclosures today are adequate, but we want to make sure that if there are joint ventures out there, we know about them, they're properly disclosed.
And Fred, just to clarify some other discussions we've had about this, these are done because they're required to create sort of one contractor in a large project. It's rare that there's actually any money made by the venture itself. The risk sharing also doesn't generally take place. So you're responsible, in the old days, they'd have two contracts, and now they don't, or two or more. Now they have one contract and a lot of participants, but they align. So it's a joint venture technically, but as we think about accounting, there's not really a risk transfer or an equity earning opportunity inside the entity itself.
And maybe just to add on, I agree with everything you said, Jerry. One of the other complexities that they posed to us was the application of the consolidation guidance, because they're required to run the 810 consolidation guidance. And so that determination, we've had conversations at the board about determining when I have a VI and a VIE, they're having some struggles with, like, say, for example, is the sufficiency of equity and some other of the criteria as it relates to these types of arrangements, which aren't necessarily sort of traditional.
Thanks for that. Any other questions or comments on liaison meetings? Excellent. Then we're on track to move to topic 2, to talk about employee stock ownership plans. And this has been an issue that has been raised to us by a fair number of users of financial statements in the last few months. Today's discussion is really to help inform the Private Company Council about whether we want this to be on our research agenda that we ask the FASB staff to work on. And if we conclude we do, then we would probably have a more in-depth education session the next time, a time soon when we're in person, to go through to make sure we all are on equal footing about what ESOPs are and how they work and what the ramifications might be for some of the things that are under consideration. But with that, I'll turn it over to Jen to talk about the memo that's in your packet.
Right. Thanks, Jerry. So with the completion of past PCC agenda priorities and continual progress being made on current priorities, the PCC has an opportunity to discuss an additional area of research. And as Jerry mentioned, the discussion topic today will be employee stock ownership plans, or ESOPs, and that's from a plan sponsor perspective. Employers are required to give a put option to participants holding ESOP shares that are not readily tradable, which on exercise requires the employer to repurchase the shares at fair value. So that's referred to as a repurchase obligation. GAAP requires an entity to disclose the existence and the nature of any repurchase obligation, including disclosure of fair value of the shares allocated to participants as of the balance sheet date, which are subject to a repurchase obligation. Repurchase obligations are not required to be reflected as a liability on a private company ESOP sponsor's balance sheet. For comparison purposes, a public company ESOP sponsor reflects the maximum possible cash obligations outside of permanent equity. The PCC has obtained feedback on ESOPs from private company lenders, sureties, and some practitioners and preparers. Additionally, the FASB received feedback in response to its recent agenda consultation invitation to comment. So to summarize the feedback provided to the PCC, private company stakeholders noted that ESOPs are becoming more prevalent, with some specifically noting that there was an increase in ESOPs in the construction industry. In two separate PCC liaison meetings with private company lenders and sureties, both identified ESOPs as a top priority and indicated a need for enhanced information in a plan sponsor's financial statements, particularly around repurchase obligations and funding strategies. One of those sureties acknowledged the difficulty of the accuracy and auditability of repurchase obligations on a longer-term horizon. In a recent liaison meeting with practitioners who focus on the construction industry, they also identified ESOPs as a top priority and indicated a need for enhanced disclosures. The FASB's invitation to comment included questions pertaining to disclosures on repurchase obligations. Of those who responded, most identified the topic as a low priority. A few identified the topic as a top priority, and some stakeholders were neutral on the priority. Additional details on feedback are included in paragraphs 19 through 33 of your memo. Your memo also includes statistics and other information from the National Center for Employee Ownership, and that's in paragraphs 13 through 18. So there are a couple of questions for the PCC today. Do PCC members want to research ESOPs from a plan sponsor perspective as part of their agenda priorities? If so, does the PCC want to focus its research on presentation, disclosure, both? And if PCC members decide to research ESOPs, it would be helpful. What would be helpful for PCC members to learn about in a future education session? So with that, I'll pause for feedback.
Robert?
I think everyone knows this is something that's been a hot button of mine for a long time, because I think in companies that have ESOPs, this is a real risk. And there's two levels of risk here. One, users may not understand the claim that's on the equity of the company, and that's a bad thing. But a worse thing is, I believe many of the owners and managers of companies with ESOPs do not understand the bomb that they're setting on that could be detonated at any time. So I think this is one of the most important things that we could talk about in my tenure here. I think we need to research this carefully on both a presentation and a disclosure. I would encourage everyone, I think we all need to be up to speed on this, because I think this is a ticking time bomb in many companies. And everybody likes these deals, but they certainly need to understand what they have and what the risks are associated with them.
Thanks for that, Robert. Brad Hendricks?
Yeah, I'd be in favor of looking into this as well. One of the questions I have, though, is it seems that the main ask, at least in the memo as I read it, is some disclosure that would enable a better understanding of future cash flow payments. And they even propose a 5-year, table going forward. I guess I don't understand how you would create that table, because the payment isn't based only on the people that are going to leave and demand repayment if they choose lump sum or if they choose deferred, but also on the future share price, which are we going to ask them to project 5 years share price in the future? I'm not sure how this table gets made to provide really useful information. And so I'm a little wary about the specific request, but do believe it's an issue we're hearing a lot of interest in and would be interested in learning more.
Thanks, Brad. And I think you're raising the challenges that others have raised about this topic, which doesn't mean it's still not important to people. Adam Roark?
Great thing about going through is I get to mostly echo Brad's comments. I want us to dig into kind of where some of the challenges might be, but I think it's worth some research. It's definitely worth an education session. For me personally, I'm not an ESOP expert. I'd love to spend some time understanding how we got here in private versus other display, and along with that education session.
Thank you for that. David Hoagland?
Yeah, I guess I would echo some of Robert's concerns. 3 years ago when I joined, I didn't know how to spell ESOP, but today I think that it's more and more prevalent. Maybe that's the private valuations of smaller companies. I think that lenders struggle with some of these obligations and how to treat that. And so, providing disclosures is going to help. To Brad's point, we can make our own assumptions around some of the things that might be in a table. So if there's proper disclosure, we're going to take a crack at that as a lender. And so, the more disclosure, the better. And obviously disclosing the assumptions that would go into such table, we can all take that and sensitize it from an obligation standpoint. So I think more information is going to be better so that we can certainly look at what we think the impact of the company and when we're lending to them or relying on them to make a lease payment, or if there's some arrangement with an ESOP that we need to kind of dig under the surface.
David, thanks for that. Thanks for those additional clarifying statements that could help. Autumn?
Yeah, I think mostly we'll echo what everyone has said. I think that we should be looking into this both from a presentation and a disclosure perspective. I share the concerns that were outlined already. And then one thing I just wanted to call out, though, is I read through the memo. It talked about, I think there's about 6,500 ESOPs in existence. And so I think that lends itself to the mixed feedback that we're getting on the importance of this. But one thing I think that's important for us to understand is how have the trends been, right? Like if this is something that's really increasing in frequency, it's something that we should be getting ahead of now. And so that's something for me that I think I would like a little bit more information on.
Thanks. Doug?
Yeah, I think I would reiterate everything everyone else has said. Just to put my vote in, I agree additional research would be warranted here. I would definitely be in favor of additional just education sessions as a PCC. I don't personally have a ton of experience with ESOPs. That said, there is a lot out there on them. I spent a lot of time doing some personal research on it in preparation for this meeting. And I do think there's just a lot of complexity to unravel there. I think from a scoping perspective, it does seem that repurchase obligations is where we would want to narrow in on the ESOP conversation. I suppose the only additional comment or I guess feedback I would have on like a future research project would be, I think a lot of what I'm hearing is there's a desire from both a presentation and a disclosure perspective. Certainly from a disclosure, I understand that there's already disclosure requirements today for plan sponsors to follow. And so I guess I do have some curiosity around, is the issue today just diversity in practice on how the disclosure requirements are currently provided or adhered to versus a real standard setting issue? And I think from a presentation perspective, public companies are required to present repurchase obligations as mezzanine equity, which is not a presentation that private companies historically have been able to or have been required to follow. And so, I think if we were to look at presentation issues and opening up a world in which private companies would have to present a similar mezzanine equity, I think would be a pretty substantial change to financial reporting for private companies. And so I think the disclosure element of this, to me, is probably most impactful for private companies and hopefully for users to get the information necessary to reflect that faithful representation of what those future repurchase obligations. And then maybe my final comment would be, I do share a lot of similar sentiments as Brad on the future repurchase obligations are subject to a lot of different things, the timing of when those employees retire, the share value as of that date, a lot of which how you project is very difficult. So I think there's a lot to sort of unpack there, and definitely think it's worth our time and attention as a PCC to continue to research and discuss.
Thanks for that, Doug. That can go into the staff's evaluation as they move forward with this if we decide for that, what seems like we are. Wim.
So I want to take this opportunity to pile on, but I agree with really everything that's been said. Autumn, to your point, it was interesting that from 2015 to 2023, there really hasn't been much of a change in the number of companies, number of private companies that have ESOPs. I don't know anything about ESOPs either. I've never done really any work with them. I do think that it's worth doing some more research on it. I don't know the path forward though, because I do think it's going to be very complicated to try to estimate what the timing and what the amount of those payments would be, but I do think it's worth researching.
Thanks, Wim. Dave Pesch.
Yeah, I'll add on to what Autumn and Wim just said. I'm unsure of the accuracy of those numbers based on what I see in reality of the number of new ESOPs coming up. I mean, they're touted everywhere as a continuity method. If you want to get out, we're into an aging issue within many industries, but if you want to get out, here's two options: private equity or ESOP. And I'm certainly seeing a lot more ESOPs. I can say that in the past, when you go back into the 2001 to about 2003 or 4 era, you saw a lot of failed ESOPs as a result of unexpected cash flows. So that's always been my interest in wanting to do something with disclosure of the potential of future cash flows. And I'm with everybody else. I'm not sure how we get there, but I think we need to look into if we can get there. But I think we need to dig a little bit more on the statistics. I'm seeing far more ESOPs being created than ever before. But maybe ESOPs are being unwound or the companies are ultimately failing that result in a net no growth.
Yeah, the numbers that you're seeing in the memo were based on Department of Labor filings through the end of 2023. I'm not certain if maybe there's other sources that we can get more updated information, but that at least that's what you're seeing is through 2023. So some of the feedback we're hearing where there's been increases in the last couple of years, they're just not reflected in there.
So that would be ESOPs created before calendar year end 22. So at this point, that's almost 4 years ago. So there could still be an industry spike going on. Christine?
Yeah, I think I just wanted to delve in a little bit more to what Doug was saying. I had the same kind of question because currently the disclosure requirements would include the fair value of the allocated shares at the balance sheet date. So you should be getting the fair value of essentially the repurchase obligation at the balance sheet date. So I'm just wondering if David and Robert are seeing those disclosures. Are you getting that fair value information? Or are you just not getting it?
To be fair, I would just say, just to respond directly, I would say, I'm not as familiar with them. They don't really come through in my space, but I do know, that we've decided as an institution to start lending to them, and we do struggle with probably more, we have access to management, so it's probably more of a just struggle with how these obligations, how we feel about the obligations. But I don't know, Robert, if you have a different view, seeing more of it.
Yeah, I would say it's my experience. They are not they are inconsistently prepared. It's not always present. And I just think there needs to be more structure put around them because don't see it all the time and they're not consistent.
Yeah, I'll just echo that it's we're not seeing the future. What we would like to see is in some fashion a rolling disclosure of the future potential. I realize you can't deal with resignation, but you can look at retirement age and the potential at retirement age. And we're simply not seeing anything with that disclosure. Valuations, yes, we get that information, but not with disclosure of, hey, you have next 5 years, you have 19 people owning this many shares at this current valuation that are retirement age and can step up and say, okay, I'm out, give me my money. And I know from the early 2000s failure, that was a significant piece of why they failed.
Okay. Yeah, it seems like the disclosures, if the disclosures that are required are being given today, the amount should be known, like the total amount should be known. But then it comes down to when is that going to have to be paid? So I think, Brad, to your point, when you were talking about estimating the future price of the stock, I don't think we should get hung up on that because the best estimate of the price 5 years from now is the price today. So, I mean, I don't think it's in terms of what is the total amount of the obligation at a point in time. It's when is that going to have to get paid? And so it might be something as straightforward as providing disclosure of upcoming retirements or other triggers that are observable that could result in a requirement to pay out on those obligations. Or the other thing I was thinking, I don't know if it would be helpful, but would some 5-year chart of what's been paid out over the past 5 years be helpful in giving you a sense of what might be coming down the pipe, or is that too backward looking? But
thanks for that, Christine. I mean, from a business standpoint, to give you some perspective on what happens, and so I know this is the existing management of a company will pay more than others for a company because they're buying their jobs. So in the 2001 to 2005 cycle, the valuations plummeted after the dot-com boom because people sold their businesses in created these ESOPs in high valuation periods. They became over leveraged. The challenge is the people that lead the buy are often very senior in the organization. So that stock turnover in that subsequent 5 years is often the same people who prepared to buy the company the first time, which is the highest dollar amount of exposure the organization has also. So those are rudimentary explanations, but the business cycle is management buys from a shareholder. Management is normally older and closer to retirement than a large part of the populace. Katina?
Yeah, I was just going to weigh in on what Christine was mentioning. I've had limited experience with ESOPs. I think I've only had one client through my tenure that I've worked with that had one. But I did see, and as we were researching that one, looked at some other filers, I do continue to see, or not filers, I guess I should say other private companies, I do continue to see that disclosure being adequately made. And so I do have some concerns that, a 5-year table or something like that has so many estimates, kind of involved in it that perhaps it may not be providing decision useful information just because of the, the uncertainty around what a table like that, it may be built from.
Hillary and then Robert.
And appreciate the discussion. And certainly I think there's a lot of things here that could be researched. One thing I think, and this probably tags off of what Doug was saying, was with regards to presentation guidance.
I guess, just something to keep in mind, right? If this is a situation where the PCC thinks that there should be different presentation guidance for ESOPs and thinking about it more like a temporary equity, I guess there's a question of, well, are there follow-on implications of why not any other equity that has a redemption feature? So just something to keep in mind. I'm sure that's something that will be considered from a research perspective, but I know my previous life, a lot of private companies would not have wanted a more broad look at, a temporary equity type of guidance for private companies.
Thanks for that. Robert?
Well, one of the things that's interesting to me about this is it really plays a lot on human emotion too, because this is a continuous call on the equity of the company. It's my experience, most human beings do not call in good times. They call in times of uncertainty or when there's fear going on. So it's my opinion that the calls on the ESOP will be greater when the company's facing uncertainty, because people might say, I got to get my money out now. And I say all that to say, I'm afraid calls on ESOPs, it'd be interesting to see, calls on ESOP, in my opinion, would increase when the company's stressed more than when things are doing well. So to me, that's some of the passion behind these disclosures is it's a continuous call that's likely, in my opinion, to happen more often in bad times than in good times.
Thanks, Robert. So I believe the consensus, we're not required to vote on this. I believe the consensus is we would like more research done, and we also would like more education. And I think the combination of those will put us in a position to decide what are the issues that we think are addressable by us in, as we've talked before about, in a reasonable amount of time and a reasonable amount of effort. And one of those dialogues can be whether or not we encourage the FASB to take the project on in addition to or instead of the PCC, but that's for a future date. Any more questions or comments about that? Otherwise, we'll have the agenda. This will be on a discussion agenda as we go forward. Brad?
Yeah, just to follow up, in terms of the additional research, I would love to see that targeted towards the investor group. I think of the outreach that was done, we showed, 18 points of view that we talked to, only 2 were investors, and it feels like what we're trying to respond to are investors getting the information they need. And so if some of that could really target investors, I think that would be useful.
Great. Thanks for that additional comment. Okay, on to topic 3 and subjective acceleration clauses and related disclosures. And Ashley's going to lead us through the first part of the dialogue.
Great. Thanks, Jerry. At the March 2025 PCC meeting, members requested that the FASB staff research the guidance on subjective acceleration clauses, or SACs, as I will refer to them here on out, and determining the classification of debt as a current or non-current liability. During today's meeting, the PCC is expected to decide whether to add a project on this issue to its technical agenda or to recommend that the board add a project to its technical agenda. Additionally, the PCC is expected to begin and potentially complete initial deliberations. For this topic, I will introduce each section as outlined in the memo, and then we'll pause for any discussion before calling votes, which Nellie will be helping to call. So I'll start by providing a brief summary of recent outreach activities, and then we'll tee up questions 1 through 3 related to the agenda decision. Since the materials were distributed for the December 2025 meeting, the staff has conducted additional outreach with practitioners and users. A summary of feedback from that outreach was included in your materials, so I won't go through all of that, but we'll provide a quick update of the February Surety Industry Liaison meeting, as that was not included in your materials. Broadly, Surety supported removing the probability assessment and replacing it with a trigger-based approach, noting that a trigger-based approach is currently how they evaluate such clauses when making decisions. Moving next to the agenda decision, to assist the PCC in determining whether the PCC or board should add a project, the staff evaluated the board's agenda decision criteria. Based on feedback received and the staff's research and analysis, the staff believes that an identifiable and sufficiently pervasive need to improve GAAP exists because subjective acceleration clauses are pervasive in the debt agreements of most entities. The guidance can be complex to apply and is sometimes overlooked, resulting in diversity in practice. And the guidance is outdated, and therefore financial reporting outcomes may not always provide decision-useful information. The staff also believes that technically feasible solutions, which we'll discuss in detail next, exist, We think that minimal costs would be incurred to apply the proposed solutions and therefore think that the perceived benefits of the solutions are likely to justify the expected costs of change. The staff does not think that the issues being contemplated in the memo are unique to private companies and thinks that the potential solutions would result in better accounting for all entities, not just private companies. Additionally, the staff thinks that providing an alternative only applicable to private companies could further complicate the debt classification guidance. For these reasons, the staff thinks that all entities should be included within the scope of a potential project and therefore thinks that the PCC should recommend that the board add a project to its technical agenda. If the PCC decides to recommend that the board add a project to its agenda, the PCC will still be expected to address all the questions in the memo today to inform the board of the PCC's views. And if the project is added to the board's agenda, the PCC will continue to be involved in all stages of the project. The staff also analyzed the Private Company Decision-Making Framework, or PCDMF, concurrently with its evaluation of the agenda decision criteria. The PCDMF does not specifically address private company classification differences, which this issue would fall within, and therefore the staff considered Chapter 3 on display or presentation differences and Chapter 1 on recognition and measurement differences. The staff also considered Chapter 2 on disclosure differences to analyze the disclosures being considered in the memo. The PCDMF includes an overarching principle that user relevance should be the primary focus before considering the cost and complexity for preparers. User stakeholders have indicated that lenders rarely enforce SACs, and some have noted that preparers should not be responsible for assessing the likelihood that a lender would exercise the SAC. Additionally, users have noted that their analysis would not change if SACs did not affect debt classification until triggered, and some noted that they already use a triggered-based approach in their analysis. The staff thinks that the PCDMF could support some of the changes being considered, such as changes to the probability assessment and the related disclosures. However, because other proposed solutions could affect the classification of debt, which would impact key financial metrics that users may rely on, such as working capital ratios, the PCDMF analysis, and potential consideration of a private company alternative is more challenging. Because of this and the reasons I previously mentioned, the staff recommends that the PCC recommend that the board add a project to its technical agenda. I'll now hand it back to Jerry to open up the discussion, and then Nellie will call out votes once members are ready.
So there's some, probably some scoping issues that we want to talk about through the rest of the agenda. But this first step is just going to be whether or not we would recommend to the board. And I want to lead with telling you that the technical advisory committee met yesterday, and I'm going to say unanimously, we weren't all there, but all of us that were there recommended that we do ask the FASB to add this to its agenda. And so with that backdrop, 4 members talked about it and reached a conclusion. But to go on with the dialogue, we'll start with Adam.
I'd like to start by just saying thank you to the staff. The research was outstanding, and a lot has happened since our last meeting, so really appreciate the efforts here. And I know I'm a big supporter of this project, and I think there's a real need. And I was hoping you could, I know we've got some board members present. We've lifted things up to the board before. I would just like to hear kind of what that would look like in this particular case, if anyone has any insight or guesses on what that might look like as we make this decision.
Jack or Sue, do you guys want to comment on that?
Well, sure. So I think, there's been circumstances and historical circumstances where, the PCC has chosen to make a recommendation to the board in order for, maybe it's an issue that is broader than just private companies. Maybe it's an issue that is fairly complicated. From an efficiency perspective, I think that, from a timing perspective, I think that the board has a little bit more flexibility in determining when they can deliberate issues, and particularly in this instance, in redeliberations, particularly if you sort of play this out as it goes forward. But I think from the perspective of getting your feedback, advising the board on how they should think about this from a private company perspective is just as important. And it would be concurrent with the research that the staff would do with public companies and public company investors and preparers.
Thanks for that. And I'll go ahead, Jack.
Oh, I was just going to add, so we're in the process of going through a number of issues, so we'll just add this into the queue. And if the board were to take on this project, there'd be opportunities for the PCC to contribute to the discussion as, if it were to move forward as an ED was progress and in between, so.
Doug?
Thank you, Jerry. Yeah, I just reiterate what Adam shared in terms of appreciation to the FASB staff on the materials provided. The research was incredible. I think did a great job of laying out the issue. I know Jerry had mentioned the technical agenda committee met yesterday to discuss this as a member of that. Just reiterating the support for having the FASB add to its technical agenda. I would just say the piece of information that was really compelling to me that maybe I didn't consider before reading the materials was the evaluation of the PCDMF, particularly around the intent and ability to finance. I think if you're looking at it from short-term debt non-current debt and the removal of the probability assessment, I think there's general consensus that you're probably going to get to the same accounting conclusion from the removal of the probability assessment to a trigger-based approach. However, from the intent and ability to finance, if there is the presence of a subjective acceleration clause, you're precluded today from reclassifying that debt to non-current. The transition to a trigger-based assessment would now result in debt being classified from current to non-current as long as that subjective acceleration clause isn't triggered. And that would, in many cases, result in recognition and measurement or presentation differences, which would, I think the staff did a really great job, impact certain ratios and metrics. And so I just don't see a path where those key metrics are impacted, where from a PCDMF perspective, where those clearly are relevant metrics that users use to make critical financial decisions, that we would be able to conclude as a PCC to keep this as a PCC project. I think the relevance criteria would stop us pretty much dead in our tracks. And so I think for me, that was the compelling reason that we should really be asking the FASB staff to take this on their agenda. But with that being said, I still feel very strongly about moving this project forward. I just don't think for all the great reasons the FASB staff laid out, this would be something the PCC should be taking on.
Thanks, Doug. Other questions or comments on a recommendation to move it to FASB? And again, this isn't a scoping question. We'll go through that after we go through this round. So with
Jerry, Robert Messer, I would like
see you.
I would like to support what everyone else has said. This is an important project. It's got a finish line, and I think we can be helpful, but I really think the FASB is better positioned to move it across the finish line sooner.
Sue, thank you, Robert.
Maybe just, from one board member's perspective on my views on this particular project, I do think it's an important project, and I think that the staff has demonstrated through the research that it results in an uneconomic, has an uneconomic result in the way it's currently being portrayed. So at least from my perspective, I think it's a good project. And I think, from my perspective, it would be one that I would be supportive of, even though I know I'm not voting today.
Thanks for that. All right, we all know how good I am at leading voting questions. I'm not. And so Nellie has graciously agreed to walk us through voting again. And she's going to be, because we're virtual, she's going to be calling on you as individuals to respond. So get your microphones ready.
Thank you, Jerry. Happy to. The question 1 in the memo relates to questions about the issue or the research and outreach. I think we've covered that. So we will first consider question 2. Does the PCC want to recommend that the board add a project to its technical agenda on subjective acceleration clauses in determining the classification of debt as a current or non-current liability in a classified balance sheet? I'll call you each by name. Please feel free to add other commentary if you want to, and in alphabetical order, starting with Mike.
I support it. I don't need any additional commentary. I think the memo speaks for itself and all the comments raised make sense.
Thank you. Katina?
Yes, I support it.
Thank you. David Finkelstein?
Yes, I support it.
Thank you. Brad?
Yes, I support it as well.
Thank you. Autumn?
Yes, I support it.
Thank you. David Hoagland?
Yes.
Thank you. Robert?
I think I do, which kind of sounds odd answering a business question, but I do.
Thank you. David Pesh?
Yes, I support it.
Thank you. Adam?
Yes, I support it.
Thank you. Wim?
Yes, I support it.
Thank you. Doug?
Yes.
Okay. Jerry?
Yes.
Great.
Thank you.
Okay, so the PCC recommends that the board add a project to its technical agenda on subjective acceleration clauses. We're going to continue through most of the rest of the questions here to make sure we've got a fully fleshed out recommendation for the board, but we can skip question 3. Ashley?
Okay. Moving next to issue C on the probability assessment. As a reminder, the current guidance requires that an entity consider the likelihood of acceleration of the due date when determining the classification of debt subject to a SAC, which we refer to as the probability assessment. In 2015, the board added a project to its technical agenda related to simplifying the classification of debt in a classified balance sheet. 2 proposed ASUs were issued in 2017 and 2019. Those amendments would have been applicable to all entities and would have replaced the existing fact-specific guidance in Topic 470 with an overarching cohesive principle for debt classification. The amendments in the proposed update would have removed the probability assessment guidance, and instead, a SAC would have affected the classification of debt only when triggered. Triggered was described as when a borrower is notified by a lender of noncompliance, including notification that occurs when the lender demands repayment. The project was removed from the board's agenda in 2021 due to a lack of support for issues unrelated to SACs. Based on feedback obtained in connection with the previous project and current research and outreach, along with support from PCC at previous meetings, the staff recommends that the probability assessment is removed and instead a SAC will affect the classification of debt only when triggered. The next decision point for the PCC is how to describe a trigger. The PCC has had extensive discussion on what constitutes a trigger at past meetings. The previously proposed description of a trigger served as a starting point for discussion, but PCC members determined that the description could be interpreted to include a lender notifying a borrower of its reservation of rights. Members generally agree that this description is too broad and that a notification of noncompliance should not constitute a trigger, as it is often used as a warning to the borrower and would not indicate that the debt is contractually due. Ultimately, PCC members preliminarily supported to describe triggered as when a lender demands repayment. Stakeholders have broadly agreed with the PCC's preliminary observation, with a few considerations raised as outlined in the memo. The staff has provided the following alternatives to describe a trigger. Alternative C1 is consistent with the previously proposed amendments, that is, when a borrower is notified by a lender of noncompliance, including notification that occurs when the lender demands repayment. Alternative C2 is consistent with the PCC's preliminary observation, and that is, a trigger is when a lender demands repayment of the underlying debt. Alternative C3 incorporates feedback received that the description should clarify that the demand for repayment relates to noncompliance with the SAC. That is, when a trigger is when a lender demands repayment of the underlying debt because of noncompliance with the SAC. Based on research and outreach conducted, the staff recommends alternative C3. Next for the PCC to consider is how the trigger of a SAC should affect debt classification. At past meetings, the PCC expressed preliminary support for classifying long-term debt as a current liability once a SAC is triggered. The FASB staff agrees with this approach based on research and outreach, as discussed in the memo. Another issue for the PCC to consider is whether the guidance in Topic 855, subsequent events, should apply to situations in which a trigger relating to events occurring before the balance sheet date occurs after the balance sheet date. In response to the 2017 update, several comment letter respondents raised concerns about how to consider the subsequent events guidance when a trigger of a SAC occurs after the balance sheet date. In response to the feedback in the 2019 update, the board clarified its intended application and the basis for conclusions, stating that there could be a variety of scenarios that might result in a lender notifying the borrower after the balance sheet date of its intent to exercise its right to accelerate payment of the debt. Those scenarios could include events that take place before the balance sheet date or after the balance sheet date. The board noted that an entity should consider those events in determining the classification of debt by applying the guidance in Topic 855 upon the trigger of a SAC. Several practitioners continued to raise concern in response to the 2019 update and suggested including clarification in the codification, such as through an illustrative example. During recent outreach, several stakeholders have raised similar concerns about how a trigger-based approach would interact with the subsequent events guidance. Based on this feedback, the staff recommends that an example be included in the implementation guidance to illustrate the board's views from the 2019 proposed update. And draft wording of an example was included in your meeting materials. Now I'll open it up for discussion, and then we'll call out votes when ready.
Doug Yule.
Yeah, I'd like to start my comments just with a question, and particularly on the question on the last piece of what you just shared, Ashley, regarding subsequent events. I think that what was written in the memo, what you just gave a summary of, makes total sense for subjective acceleration clauses that are triggered before the balance sheet date, where a demand letter is received after the balance sheet date, having to do an assessment of when those events occurred to determine when that reclassification should occur. My question is more around, and I can't remember the paragraph number, but where it talks about the subsequent events that typically happen during the demand letter process, where a company is generally notified, then there's a reservation of rights, then a lot of times the demand letter is issued, and then many times those demand letters include cure events that the company, if they were able to cure the events of default, would ultimately not be required to repay. I think the question I would have is, in those events, if a company receives a demand letter before the balance sheet date, but then ultimately is able to cure whatever events of default under that subjective acceleration clause, how would that ultimately be contemplated from a reclassification? Would that be something that this alternative would address, or do we think as a group that it's something this alternative should address in a similar fashion as an example, or would this just be something that would be subject to subsequent events, where the demand letter was received before the balance sheet date, you would therefore be required, as the trigger would say, to reclassify the debt as current, and then if you were able to cure post the balance sheet date, because those events happened after the balance sheet date, it would be a disclosure. Just curious as to that, because the impression that I get many times is that those cure events do exist, and maybe this is something just from a prevalence perspective that the users in this group could help shed light on, but just curious as to how we would want to address those circumstances.
Thanks for that question, Doug. David, Robert, or David Pesh, any reaction to Doug's question? And David P. has his hand up, and David Oakland does too. Go, David H., you're first.
Yeah, I mean, that was one of the comments I was going to make, Doug, and I think it's a good one, right? Like, if we do put out a, let's call it a demand letter, right? The customer, according to the credit agreement, is going to have some sort of cure period or period of time at which that can be solved, or maybe the demand letter gives them additional time as well. So I would think if we're going to phrase this, it should be after all kind of cure periods and periods of time that the lender permits, right? That those have all lapsed in some sort. I think would be, if I was to amend, what was it, C3, it would have something to do with cure periods, because if it's monetary default, it's one thing. This doesn't feel like a monetary default. It's more of a subjective situation, and so there's going to be longer cure periods for some of those elements. So we just got to make sure we're being thoughtful about that language.
So to follow up with you, David H. So you would like it to be classified as, and I'm going to say as callable until all the cure periods are resolved? Or do you want all the cure periods to also be resolved?
I think you have to let those lapse, I guess, in order to make the change, right? It's going to happen, but is there something that they can do over that time?
Okay, thank you for that.
Even if it's a monetary default, right? They have 3 to 5 days, right, to fix it, right? We're not talking about those, but there is going to be a period of time, of which a lot can be extended, right? So if we're calling this, they could get 30 days, then another 60 days if they're pursuing it. So we're talking about a potential long period of time as we think about that. And I'm not, lenders are all going to have different views of, well, do we send it now and then the period starts? So I think some of those are harder to put in writing, but I would think we'd want a lot of those periods to have expired before we make a drastic change to the accounting. My opinion.
David P.
It's funny, I'm kind of on the other side of the fence. I believe whatever the status of the debt is at the statement date should be how it's presented. But this is where the subsequent event disclosures become more important. If it was presented that way and then subsequent to the statement date, just like many other subsequent event disclosures that come through, the subsequent event disclosure says that was cured 5 days, 15 days, 30 days, 60 days, doesn't matter. It was cured prior to the issuance of the financial report. The user is going to see that note and go, okay, well, it's carried there. I can move it back. But if you get to the publishing of the statement and it hasn't been cured yet, that makes it pretty easy. So why have a different presentation at the statement date, whether it's been subsequently cured or not? Presented as is. That's just the way I would prefer it.
Thanks for that, David P. Mr. Chang, did you go away? He went away. Robert M.
Yeah, I think one of the things as a user that's to keep in mind is the context. Typically, if these are triggered, there's something else going on. And though whatever's going on here that caused this level of discomfort or whatever you want to call it, I don't know if that'll be covered in the disclosures or it might just be knowledge that you have from being around the company. But I think I'm on the side, if you make the demand, even if there is a cure period, it needs to be the facts that day. Because that's the way it is. And then the question will be about what caused that or what the trigger was and how it was resolved.
Thanks for that. Doug?
Yeah, no, this has been great discussion. And really the reason why I asked the question, I think sitting in the seat of a preparer and the reality that subjective acceleration clauses are by name and nature subjective. If you receive a demand letter and it's because you didn't respond to the reservation of rights or previous notifications and you say, well, this subjectivity, like I've got this, like I have I've got to do whatever I need to do to respond to this demand letter to make it go away. And I feel highly probable that I will do that. My preference as a preparer would be to continue to present that debt as non-current and maybe even make the argument that even though I received the demand letter, all the facts and circumstances exist as of that date that I can argue that I can squash this subjective acceleration clause. So I think that's where things get sticky and it almost feels like you're getting like another probability assessment baked into getting rid of one probability assessment. Now, if cure periods exist in every demand letter, you're gonna have circumstances where every company receives a demand letter and then you have a set of stipulations on how you might cure that. And so I just think that the alternative is going to need to sort of directly address, like if the trigger is the demand letter, to Hoagland's point, if we adjust the trigger to say, hey, you receive a demand letter, but if there's a cure period, then it's really not triggered until the cure periods lapse. That's one thing. it either needs to be that or the trigger is the trigger, which is the demand letter. And preparers don't really get this option of like, because subjectivity of the clause would say that like, if it were a monetary or quantitative threshold that like, oh, they just calculated the metric wrong here, that would be one thing, but the subjectivity of it all so I don't think as a probability metric, a company would be like, well, I think I'm probable of being able to cure this or not. So I can just see that being an area of stickiness in terms of application of the trigger, and if there's a cure period, how that affects, how you assess that trigger. So that's the reason why I bring that up.
Thank you. Mr. Chang.
Sorry, I'm back. Yeah, I think I would support either approach. But if I had my vote or I could decide, it would be that if there's a demand for repayment, the curing period does not come into play, because I think it just adds complexity. I think we're here because we're trying to get rid of a probability assessment of likelihood. But I think if you step back, the probability meaning in reality, how often is this going to occur? So you're going to have a situation where a borrower has not tripped up anything else, right? So I guess the example is the customer loss. That's probably one of those scenarios that could occur. And you got a demand repayment after the balance sheet date with kind of a cure period. Like I just don't think it's going to be as common. So I'm supportive of either approach, but I don't think we should introduce complexity by doing another probability assessment in these events. I think we should just keep it simple, and disclosure can be a preparer's friend, right? Saying it triggered current classification and disclosed that it's due to a MAC provision or material adverse clause, and there is a cure period in which they're resolving. So I think there is disclosure that could help the preparer.
Thanks, Michael. Robert M.
Yeah, this is something you don't get to talk about a whole lot, so it's kind of fun to do. To speak to the other side of that, I know these letters typically say notice of default and intent to accelerate. So I think part of the research should be around that. Is it truly current when you get the notice of default, or is it only triggered when you have the intent to accelerate has actually occurred? So I just raise that as something to be thought about as the research is developed.
Thanks for that feedback. Hillary?
I think this issue has come up, or the question about how do we look at subsequent events. I think the conversation we're having about some of the challenges that may result if we are to look at the subsequent event guidance may be similar to how we had looked at it in a previous project. So what I really wanted to say was I do think it's fair for the PCC to have a discussion of whether they want to kind of apply the subsequent event guidance or whether want to look at it as of the balance sheet date, what was the trigger triggered or not, and not have to then subsequently evaluate what happened in the period thereafter. I think that's fair for purposes of bringing that back to a recommendation to the board, right? I do think this issue, we are intending to simplify the application of the guidance. And I think that's a fair conversation for the PCC to have and for the board to consider as we think about this.
Thank you. David Hoagland.
Yeah, I just want to amend my comments. I think Mike makes a convincing argument that this is so rare that if someone's going to actually send a demand letter over it, they're probably pretty serious about it. They don't take that lightly given the subjective nature of it. So I think he's probably right in that, there is something to the point that if you actually get one of those, right, and it's, because you got to be pretty confident that, you've got two legs to stand on here. So thanks.
Thanks for that clarification. Any other comments before? Hillary?
Maybe just one other question. I'm not sure if we're getting to this, but do you think that if this goes to the board, that the board should have to provide additional guidance on what it means to be notified, that the acceleration has taken place, like the demand repayment. I guess this is coming from my auditor background. What does it mean to be notified? What is going to be that audit evidence associated with that that's going to make it objective and auditable? Be interested in the views from the PCC members with regards to whether we think that needs to be specified in the guidance or whether judgment can be applied.
I think part of the research should be us talking to lenders about what do they say when they demand payment. You know, if it's is it more ghostly than it is substantive? You know, I think that's really the question. My opinion is that we focus on the fact that it's a real letter that says, give us our money back. And, you know, those are your options. Now let's figure out how you're going to give us our money back. But you know, I look to the rest to say whether or not that's sort of how we viewed this question. Adam?
It's how I view it, but I do think, to your point, Hillary, we would want some really careful descriptions of what is meant in the definition of the trigger. Is it demand for payment, not just a notice of non-compliance? Because the wording can get tricky. Probably need some input from the user group here and types of letters their institutions, you know, would be delivering, so we can look at that language. But certainly from the audit perspective, to me, I would want something that really I could hone in on. Well, that's a demand for repayment. To Cherry's point, give me my money, and try to keep it as objectionable as possible.
Because one of our points, the reason we got to this was that the subjective piece, no one knows what to do with it, because often they're in play even when nothing bad has gone wrong. However, it requires the management and the auditor to go through some sort of fulsome evaluation of that, and that may or may not. There could be beauty in the eyes of the beholder sometimes on those things. Nellie's up.
Okay, our plan here is to vote on 4 questions together. Question 4, 5, 6, and 7 from the memo. So question 4 is, do PCC members agree that the probability assessment guidance in paragraph 470-10-45-2 should be removed, and instead a subjective acceleration clause would affect debt classification only when it is triggered? Question 5 is, do PCC members agree with the description of triggered recommended by the staff? Question 6 is, do PCC members agree that once a subjective acceleration clause is triggered, the related debt should be classified as a current liability? And question 7 is, do PCC members agree with adding an example to the implementation guidance to illustrate the application of the subsequent events guidance? I will note that the staff recommendations are summarized in Appendix C of your memo for each of these. And if you want to vote that you agree with the staff recommendations on all 4 of these questions, you can. You don't have to, obviously. And I will call you each by name, starting with Doug.
We're going in reverse order this time, Nellie. Way to switch it up. I
didn't realize my methods.
Yeah, I got you. I would vote yes to all 4 of those questions, with maybe the only caveat to number 7 for the illustrative examples to maybe cover some of the points that I raised regarding other ways that subsequent events criteria could be applied in this circumstance. But otherwise, yes, I vote yes to all of them.
Thank you. Wim?
Yes, I vote yes to all 4.
Thank you. Adam?
I vote yes to all 4 in agreement with the staff recommendations.
Thank you. David Pesh?
Same. I vote yes to all the staff recommendations.
Thank you. Robert?
I vote yes.
To all of the questions, I assume.
Yes, to all the questions. Yes, ma'am. I'm sorry.
No problem. Thank you. David Hoagland?
Yes to all the questions.
Thank you. Autumn?
Yes on all 4.
Thank you. Brad?
Yes, on all four, with just one comment on number 6. I don't think this is likely, but if it could be accelerated, but the payment actually take place over more than a year. I have never seen one of those, but I would like some clarification on what happens if the acceleration is of a duration that extends over 1 year.
That's a good question. We can consider that. That might factor into how we describe a trigger is my only thought, but we noted your observation there in question 6. David Finkelstein.
Yes, in line with the staff recommendations. And second Brad's comment on that. But I presume that would probably be covered in how the language would be written.
Thank you. Katina?
Yes to all 4.
Thank you. Mike?
Yes to all 4, but consistent with Doug, I'd like to understand the discussion on the subsequent events, meaning follow up on where we landed today.
Okay. And Jerry?
So yes, and one of the reasons we took this topic on is because lenders don't do this with subjective acceleration clauses. So I know we're putting in some caveats about when it wouldn't be current, but we already believe that this is so rare that it never happens. So now I just want to clarify. So I don't think the staff is going to find a rarer event where it happens and they don't want their money back fast. But yes to the staff recommendations.
All right. Moving next to the guidance on the intent and ability to refinance short-term debt on a long-term basis. The current guidance states that a short-term obligation may be excluded from current liabilities if an entity intends to refinance the obligation on a long-term basis, and that intent is supported by an ability to consummate the refinancing in either of the following ways: either the post-balance sheet date issuance of a long-term obligation or equity securities, or by entering into a finance agreement that permits the entity to refinance if certain conditions are met. One of those conditions involves SACs, specifically paragraph 470-10-45-14B1 states that financing agreements cancelable for violation of provisions that can be evaluated differently by parties to the agreement, such as material adverse change, would not meet the conditions to be classified as non-current. In other words, the mere existence of a SAC and a financing agreement intended to refinance short-term debt on a long-term basis precludes non-current classification. Feedback from stakeholders from both the previous proposals and recent outreach has indicated that it is rare in practice for a financing agreement to be used to demonstrate an entity's intent and ability to refinance, and rather, entities typically consummate a refinancing through a post-balance sheet date issuance of a long-term obligation. At the September meeting, PCC members broadly supported making conforming changes to this guidance, such that a SAC would only affect classification if triggered. That is to amend the condition in paragraph 470-10-45-14B to be trigger-based. So if a trigger of a SAC does not exist, the short-term debt subject to the refinancing agreement could be reclassified to a non-current liability, assuming the other conditions are met. Generally, stakeholders have supported the PCC's preliminary observations. The staff has provided 2 alternatives. Alternative D1 would amend the condition to be trigger-based, and alternative D2 would not amend the condition. On the basis of research and outreach, the staff recommends alternative D1, and that is that the condition be amended to be trigger-based, consistent with the changes made to the probability assessment. I'll now open it up for discussion.
Mr. Doug?
Yeah, I think probably getting ahead of the vote here, I'm in support of D1. I think consistency of having the trigger event be consistent with the initial discussion of removing the probability assessment. I think the intent and ability to finance, we should be consistent. And I think that consistency then results in us needing to have the FASB take this on. So I think it all goes part and parcel. So yes, I agree. The trigger should be the triggering event should be applied in the intent and ability to refinance, and that the probability assessment would no longer be applied in that circumstance.
Great, thank you for that. David H.
I would say the only difference in my mind, if I'm understanding it correctly, is, if you're thinking about a future lender versus an existing lender, I would say folks that don't have the money out already are probably more likely in a change in circumstances, whether that be with the company or with the market, would be more willing to pull this in uncertain times than, an existing agreement with a SACS in it. And so that would be my only observation. I'm not sure it changes my opinion about it, but it's something we should probably think about. But again, if I'm misunderstanding when this would happen, that might be just on me.
So you're talking about ability being predicated on, I'd say, the cash from the second lender being available, not the cash being promised by the second lender.
Right.
Okay. Michael Chang?
Yeah, that is a requirement that the lender has the ability to finance. So that's already included. I think my understanding is the only thing we're going to remove is the existence of a SAC.
Thanks, Michael. Other feedback? Then we'll go to the vote.
Okay. We are voting on question 8. Do PCC members agree with the staff recommendation on the guidance on the intent and ability to refinance on a long-term basis? The staff recommends alternative D1, amending the condition in paragraph 4510B1 so that it is trigger-based. I'll call you each by name, starting with Robert this time.
That is sneaky. Yes, I am in favor.
Thank you. David Pesch?
Yes, I'm in favor.
Thank you. Adam?
Yes, I'm in agreement with the staff.
Thank you. Wim?
Yes, I'm in agreement with the staff recommendation.
Thank you. Doug?
Yes, I'm in support of D1.
Thank you. Mike?
You tricked me there. Yes, I support alternative D1 for question 8.
Thank you. Katina?
Yes, I'm in support.
Thank you. David? David Finkelstein?
Yes, I'm in support.
Thank you. Brad?
Yes, agree with the staff recommendation.
Thank you. Autumn?
Yes, support option D1.
Thank you. David Hoagland?
Yes.
And Jerry?
Nellie gets her fun wherever she can. Yes, I'm in support.
All right, moving next to revolving credit agreements. The current debt classification guidance provides guidance on revolving credit agreements with features such as lockbox agreements and SACs. This guidance intersects with both the probability assessment guidance and the intent and ability to refinance guidance, and therefore the PCC should consider whether conforming changes are needed. During the September meeting, members preliminarily supported making conforming changes to this guidance. The staff also recommends making conforming changes to the guidance as follows. For long-term revolving credit agreement obligations subject to SACs, which would include agreements with a requirement to maintain a springing lockbox, under the current guidance, the effect of a SAC is determined based on the probability assessment. The staff recommends that the probability assessment is removed and classification would only be affected when a SAC is triggered. And when a springing lockbox is sprung, the guidance on short-term revolving credit agreements would then apply. For short-term revolving credit agreements subject to SACs, which would include agreements with a requirement to maintain a lockbox arrangement, under the current guidance, outstanding borrowings are classified as a current liability unless the entity demonstrates the intent and ability to refinance on a long-term basis using an agreement other than the revolving credit agreement because the existence of the SAC precludes non-current classification. The staff recommends that the existence of a SAC no longer automatically preclude non-current classification. That is, if the SAC has not been triggered, an entity could demonstrate that it has the intent and ability to refinance the short-term debt on a long-term basis if the other conditions in paragraph 470.10, 45.14 are met based on either the revolving credit agreement itself or another agreement. I will now open it up for discussion.
Any questions or comments for the staff on this topic, or are you guys ready for us to move to the voting on this topic? Nellie, take it away.
Okay, we are voting on question 9. Do PCC members agree with the staff recommendations on the guidance on revolving credit agreements with subjective acceleration clauses? And the staff recommendations are included in Appendix C. I will call you each by name, starting with Mike.
Yes, I support the staff recommendation alternative E1.
Thank you. Katina?
Yes, I support the staff recommendation on questioning.
Thank you. David Finkelstein?
Yes, I support it.
Thank you. Brad? No worries.
Yes, I'm also in support.
Thank you. Autumn?
Yes, I support the staff's recommendation.
Thank you. David Hoagland?
Yeah, I support it. Only comment I'd make is probably for revolving credit. I think the point was made earlier, if you can term it out, right? A lot of our revolving credit agreements have a term out feature. Maybe there's something to explore there in terms of classification.
Okay, thank you. Robert?
I support.
Thank you. David Pesh?
Yes, I'm in support also.
Thank you. Adam?
Yes, I'm in agreement with the staff recommendations.
Thank you. Wim?
Yes, I support the staff recommendations.
Thank you. Doug?
Let's make it a clean sweep. I'm in support.
Thank you. Jerry?
Sorry, I was a little preemptive in my clean sweep commentary.
We're all good. I support.
All right, we're getting there. Moving next to disclosures. At past PCC meetings, members discussed including debt disclosures as part of this project. Based on feedback received from members at the December meeting, a broader scope debt disclosure project will be contemplated separately from this project. The disclosures discussed in the memo are narrowly scoped to include only disclosures about SACs. The previously proposed amendments would have required certain disclosures when a SAC is triggered, and the majority of comment letter respondents supported these disclosures. During recent outreach with users, most have indicated that it would be helpful to disclose information when a SAC is triggered, but that it would not be necessary to disclose information pertaining to SACs before a trigger occurs. Some stakeholders have noted that a notice of non-compliance with a demand without a demand for repayment should not affect classification, but should be disclosed. Based on previous and recent feedback received, the staff has recommended the disclosures outlined in paragraph 155 of the memo and the period in which the trigger of a SAC occurs. Those include a description of the event that led to the trigger, an explanation of the trigger, the amount of obligation subject to the trigger, and if applicable, the terms of a waiver. The staff thinks that requiring disclosures about SACs before a trigger occurs could result in management having to assess the probability of whether a trigger will occur. And I will now open it up for discussion or vote if we're ready.
Any questions or comments from the PCC to the staff regarding this topic? Or dialogue you'd like us to entertain around the disclosures to inform the FASB? Okay, Nellie, why don't we go with the vote?
Okay, we are voting on question 10, which is, do PCC members agree with the staff recommended disclosure requirements? That recommendation is in paragraph 155 of the memo. And I'll call you each by name, starting with Doug.
Yes, I'm in support of the staff's recommendation.
Thank you. Wim?
Yes, I support the staff's recommendation.
Thank you. Adam?
Yes, I support the staff's recommendation.
Thank you. David Pesh.
I support the staff recommendation.
Thank you. Robert.
I support.
Thank you. David Hoagland.
Yes.
Thank you. Autumn.
Yes, I support.
Thank you. Brad.
Yes, I support.
Thank you. David Finkelstein.
Yes, I support.
Thank you. Katina.
Yes, I support the disclosure requirements or suggested disclosure requirements.
Thank you. Mike.
Yes, I support alternative F1 as recommended by the staff.
Thank you. Jerry.
Yes, I support.
All right. Since you have decided to recommend this to the board, the last thing we have to cover is transition. The staff recommends that the proposed amendments be applied prospectively as of the effective date to debt that exists at the effective date and after with early adoption permitted. The staff thinks that this method will be the easiest to apply, which aligns with the objective of reducing complexity and applying the debt classification guidance. Go ahead and open it up for discussion or vote.
Why don't you go ahead and talk about the comment period and let's include those.
I think because
You're not going to do that?
Because we recommended that the PCC recommend to the board to add a project, we weren't going to cover the
Great.
comment period or the costs and benefits questions because those are more moving towards issuance.
Perfect.
But we were going to ask for the PCC's thoughts on transition. If the PCC members have any thoughts or perspectives they want to share about comment period or costs and benefits, we'd be happy to talk about those too. But we weren't going to call a vote.
Thank you. Douglas?
Yeah, just a prospective, certainly the easier application. I think that would be the desired approach for many and maybe most private companies. Just curious if there's any consideration around making retrospective treatment an optional approach for companies that may want the comparability between prior periods. I don't know if there's a basis for having an optional retrospective application, but I imagine there may be some subset of companies that would desire the comparability of their presentation. So just curious if that was something that was considered.
Oh, sorry, I thought I pushed it down. Why don't we have the staff think about what that might look like? Because we've already said that this subjective piece is rare, and on the SAC. So why don't, as a part of the outreach, figure out what impact it might have if, in fact, retrospective was an option. Although I'm betting prospective is probably better for many. Dave Pesh?
Yeah, I was going to make the same comment as Doug, because if you're doing comparative financial reporting, again, rare, your double rare comment earlier, Jerry, but if you had a SAC trigger in the prior year and then it was addressed and then it was triggered again, I think a user would want to know that information if it wasn't disclosed in the prior years. So yeah, I think there might make some sense to that option, particularly in comparative financial reporting.
Okay, let the staff consider that for the FASB's consideration. Go for the vote.
Okay. We're voting on question 11, which is, do PCC members agree with requiring a prospective transition method? And we won't call a specific vote on question 12 or 13. So if you have any thoughts on comment period or the benefits and costs overall, and you want to share those, please feel free. And I will start with Mike.
I support the staff recommendation for prospective application, but I also think an option for retrospective application makes sense. So it's my vote.
Thank you. Katina?
Yes, I support prospective application, but I think an option for retrospective should be considered for availability.
Thank you. David Finkelstein?
Yeah, I do vote again for prospective, but again, I do feel in line with everybody else that modified retrospective would be allowable for comparability.
Okay, thank you. Brad?
Yeah, I support along with what Mike said.
Okay, Autumn?
Yes, I support the staff's recommendation.
Thank you. David Hoagland?
Yes, I support.
Thank you. Robert?
Agree.
Thank you. David Pesh?
I'm in agreement, but like others, I think there should be an optionality for comparative reporting.
Thank you. Adam?
I support the staff's recommendation, and just one note on item 13. I also believe that this could really add some simplification. It brings a lot of potential benefits to the process in terms of benefit versus cost analysis.
Thank you. Wim?
Yeah, I support the staff's recommendation on prospective.
Thank you. Doug?
Yep, supportive of perspective with the optional retrospective being considered. And then as for issues H and the benefits and costs, I don't have any specific comments on issue H, but like Adam, I definitely believe that the benefits of this proposed alternative would certainly outweigh the costs. And so I think from that perspective, this is definitely something that we should be pushing forward.
Thank you. Jerry?
So I'm going to make a clarifying comment, and then do you still want to comment before you finish? So if you had debt that got reclassified 12 months ago, you either paid it or you fixed it. And so I'm not sure retrospective gives you any different accounting in under this than it did then. That's a business observation, which may or may not follow the accounting standards. But anytime I've had a client who had debt as current at the prior balance sheet date, they either fixed it or it was gone. And so that's a fact, as opposed to it being, but nonetheless, that's just feedback. Jack?
I agree with that perspective. I was just going to say, if anybody has an example in mind, if we could talk about it offline, that would jumpstart the staff analysis. Thank you.
Doug, you have your arms up?
Yeah, just to respond directly, I hadn't, I to your point, Jerry, I don't disagree with that. And I probably hadn't mentally gone through all the hoops of where that may come. I think my comments on an optional retrospective approach was more just if the circumstance arose where that would be beneficial. And to your point, Jerry, that may not, from a business sense, may ever come up. And if that's the reality, then I think we could probably squash the need for the retrospective. I think my comments were more from, since I hadn't gone through the mental gymnastics of where that may appear, I thought it may be worthwhile just to call out, but for what it's worth, that was where my head was at.
Thanks for that. Well, all these have passed, so congratulations and good luck to the FASB. And we'll be hearing more in the coming weeks. So why don't we go ahead and start our lunch break now at 12:48, but if we could reconvene at 1:30 Eastern time, hopefully that works for everybody. It's a little bit shorter lunch period, but hopefully it means you'll be able to get back to your real lives faster. So thanks, and we'll be in touch soon. Okay, welcome back from our break. And topic 4, the research project on debt modifications, extinguishments, and troubled debt restructurings. And Chris is back.
Thanks, Jerry. As a reminder, following the September PCC meeting, a working group was formed to discuss issues related to debt modifications, extinguishments, and troubled debt restructurings. In November, the working group held its first meeting, and during that meeting, the working group discussed its objective, pain points under the existing guidance, and next steps. The key takeaway from that meeting was that the working group was looking for the staff to provide alternative paths to help facilitate the working group's future discussions. In line with that feedback, we developed several paths that are listed on the next slide, and presented them to the working group during its January meeting. For the purposes of our meeting today, I'm going to focus on the areas that the working group expressed the most interest in. So just using this slide as a reference, that's going to be A, B, and C1. But we'll start to go over each of those in more detail on the next slide. So the first alternative the working group discussed was potentially bypassing the TDR guidance and proceeding directly to the guidance in subtopic 47050 on debt modifications and extinguishments. We noted in the working group meeting that this alternative aligns with suggestions received in feedback on both the 2021 and 2025 agenda consultations and could provide benefits by simplifying the requirements for a borrower in the event of a debt restructuring. Working group members were strongly supportive of this approach and indicated that it should be prioritized. It was described as being potentially a meaningful simplification with manageable drawbacks. However, a user member indicated that there could be some disclosure or transparency questions and suggested targeted disclosures to ensure users were still receiving relevant information. So our next slide provides a visual overview of this approach, assuming that it is structured as a private company alternative. So to that end, the area of the working group's discussion that I'll highlight here is that during our meeting, a working group member asked us whether this should be considered for both public companies and private companies. There were also questions about whether this should be framed as an option or a requirement. And if it was limited to private companies, one working group member noted that it might be better to have it as an option, particularly for companies that might consider an IPO in the near term. So moving to the next slide. The next approach we discussed with the working group was based on retaining some of the TDR disclosures and requiring them for all debt restructurings. The thinking behind this alternative was that it could potentially be packaged together with an option to bypass the TDR guidance and/or the 10% cash flow test. We highlighted in the working group meeting that there's few disclosure requirements for debt modifications and extinguishments in current guidance, and therefore, if the TDR guidance were bypassed, it could be helpful to improve the information provided to users by expanding the applicability of some of the existing TDR disclosure requirements. So to illustrate those existing TDR disclosures, we can flip to the next slide. So to briefly speak to the slide, this illustrates an entity with a debt restructuring that is deemed to be a TDR in which all the interest payments are eliminated for 6 quarters and covenants are amended. We discussed this during the working group meeting with the goal of trying to gauge if certain disclosures, such as a description of the principal changes in terms, should be required for all modifications and exchanges. There was some mixed feedback from the working group on this approach. For example, some working group members indicated that it would be a fair trade-off to add disclosures if the TDR guidance were able to be bypassed. Others emphasized wanting clear evidence that the disclosures would be meaningful to investors before considering any new requirements in a package with a private company alternative. The working group also discussed how to best approach private company debt disclosures more broadly, given that there's been feedback as part of other projects. So moving to the next slide, we'll cover the alternative most working group members were interested as it relates to the debt modifications and extinguishments guidance in 47050. So during the discussion, the working group discussed a few approaches that would bypass the 10% cash flow test in subtopic 47050, which has been identified as an area that's challenging under current guidance. We covered a few different versions of this approach. For example, one, which is illustrated on this slide, was based on modification accounting, and another one was based on extinguishment accounting. So as a reminder, under what we're calling modification for the purposes of presentation, if we ignore fees and costs, in modification accounting, you may not have a change to the debt's carrying amount upon modification. Instead, an entity recalculates a new effective interest rate so that the current carrying amount equals the present value of the restructured payments. The net effect is that any of the changes to the amounts or timing of the payments flow through interest expense prospectively, rather than being recognized as a day one gain or loss. That contrasts with extinguishment accounting, in which a gain or loss is recognized based on the fair value of the modified debt. Furthermore, when there's an extinguishment, interest expense in the periods after modification reflects the market rate of interest as of the most recent modification. The working group indicated in its discussion that they preferred an approach that was based on modification accounting as opposed to one that was based on extinguishment accounting. Working group members noted that although modification accounting requires an effective interest rate calculation, This might be preferable to extinguishment accounting, which requires a fair value estimate. So more to that point, when we were discussing with the working group, we also presented a hybrid approach that would be somewhat similar to extinguishment accounting, but would retain the existing effective interest rate rather than using a market rate, and therefore it wouldn't have required a fair value. We generally heard from working group members that while they still preferred modification accounting to this hybrid approach, they would also prefer the hybrid approach to current extinguishment accounting, specifically because it would not require the debt to be measured at fair value when there is a restructuring. So with that context, we want to advance to the next slide to talk about next steps. When the working group discussed next steps, several members focused on outreach with users and with TIC members. And since the working group meeting, we've also had the chance to briefly touch base on this issue with the board, given the recent agenda consultation feedback, and we expect them to share some thoughts today. And the thought being that this could help start a conversation about the best way to address these issues in a way that's responsive to the feedback that's received from all stakeholders. And with that, we can flip to our final slide and open it up for discussion for PCC members and board members.
So just to remind you, the working group consists of 2 PCC members in Autumn and Mike Chang, and then there are 2 TIC members. And then Chris and his team have been, working with us. And David Stewart from, is he from TIC? No, ProSite. He's from ProSite. I knew we had a user in there somewhere. And maybe he'll be a member one day, but we don't know about that yet. So sort of with that backdrop, maybe it'd be helpful if either the working group members have some comments they want to share, or whether now is a good time for the board members who've had some time to think about this. Hillary?
I can start with just some initial thoughts. And I think that the work that's been done by the working group to think about the different alternatives that may be out there is really interesting, because I think that this is feedback that we've heard not just from private companies, but also from public companies with regards to, some of the challenges and the complexity of applying the existing debt modification versus extinguishment guidance. And actually, it is consistent with some feedback, right? We have an EITF issue that is also looking at kind of this very issue of when do you call something an extinguishment versus having to go through the modification test as well, that we haven't finalized, but I think will be in the near term. When I think of this issue, I think the one thing in kind of looking at the different alternatives that are included in the package that was sent is thinking about what is the outcome that we think provides the most decision useful information from an investor perspective. And we've heard different feedback on that over time. We've heard feedback that actually having that extinguishment gain or loss in the period where a change is made to the terms of debt is very informative from an investor perspective. So certainly I think that we've thought about that in the context of our debt exchange project from an EITF perspective. And I think from my perspective, I've thought about that if we're looking to have, move from multiple models to one model, why wouldn't extinguishment accounting be a better outcome, provide more decision useful information from an investor perspective? So that's something I know that maybe wasn't on the top of the list from a private company perspective, but is something that I think I personally would be interested in. But I understand that there's a lot of hesitation to want to move towards an extinguishment model because that requires, determining the fair value, right? And there's costs associated with that. I guess the question, I kind of had this question for the staff when we were talking about that is there a way to alleviate some of that cost, right? Thinking about new debt that's being entered into, I think at most times it's entered into at market terms, right? Is there a way to kind of presume that that is effectively, other than discounts and premiums, right, fair value of the debt? Is there something there where we could make it easier to calculate that extinguishment gain or loss, but still end up with an accounting outcome that I think could be more informative from an investor perspective? I think that's something that I'm interested in from a broader perspective to eliminate some of that diversity and, complications of having to apply a 10% test, having to do it on a creditor by creditor analysis. It gets more complicated. So that's something I think is just a thought I would put out there of, another area or another alternative to consider is there a way to make the extinguishment model easier to apply such that it would be maybe a more feasible solution? And curious if PCC members would have any reaction to that.
Christine?
So I agree with what Hillary was just saying about needing to focus on the economics and on the usefulness of information for investors. And I kind of feel like that is getting lost a little bit in terms of just the focus on trying to get to the easiest outcome possible. I also agree with Hillary that I think that extinguishment accounting, when the debt exchange or the restructured debt or modified debt, whatever we want to call this thing, at that moment in time, is being modified based on market terms. Where I get very nervous is applying that model to TDRs, where by definition, those are off-market terms. Because if you apply extinguishment accounting to one of the examples that the staff included in the materials that we received, where the amount of the future cash payments is less than the current book value of the debt. In other words, what's happening is the company is having a portion of their debt forgiven, and they are not being charged interest anymore at all. So really, it's a zero interest rate and just an outright gain from having a portion of your debt forgiven. If you run that through extinguishment accounting, what the company ends up reporting is a massive, huge gain on extinguishment and then large amounts of interest expense to unwind that gain over the subsequent period. And what would worry me from a preparer's perspective would be that if that was the accounting that I was required to apply to a TDR, that the investors are going to ignore that upfront paper gain because it's a one-time paper thing, but then they're going to not realize that those interest expense amounts are just unwinding the gain that was reported in a prior period, and they're going to state the interest charges for the company. So I think that accounting does not reflect the economics in any way and would be very misleading for investors to the detriment of companies. And I also think that if you have a situation where you've got a TDR, being transparent is of the utmost important because you've got a company that's in financial difficulty. So doing something with the financial reporting that causes the economics to be masked is particularly bad in that particular situation because you do have a company that's probably in financial difficulty and the investors really need to understand what's happening.
Michael?
I guess I'll address Christine's comment. The staff has been fantastic. I mean, they prepared a similar slide, and that was the one thing about TDR accounting that was raised. That until they kind of put that as a drawback, I didn't. I mean, I thought about it, and then I thought about it more. I don't. When we say we're going to remove TDR accounting, and I could be incorrect in my words, but I thought that we would have wanted to at least retain similar accounting guidance when the undiscounted cash flows are below the carrying value, because I agree with you, Christine. It does not make sense to book a gigantic gain to then book interest expense in the future. And if we totally get rid of it and just do modification accounting, that doesn't make sense either, because you would have a negative yield, right? You're getting paid, right? You have negative interest expense or interest income. So I do think we need to retain it. I think moving forward, the way, at least my view in terms of how I would proceed is what disclosures would need to be retained if we totally remove TDR accounting. And then to address Hillary's question, yes, I mean, I think getting away from extinguishment accounting is because of fair value. A concern the working group did raise, including myself, is that is going away from what the ITF is heading towards, where if you meet certain criteria, just account for as an extinguishment. So that is a concern I have, but I think coming up with the fair value, if there is a expedient to determine that, I mean, I'm all ears, but I think that's kind of the issue is, should there be a valuation to record a gain or a loss on extinguishment? If it's not in the TDR realm, what do users do with that? Like, will they adjust the add back? And I think we were just looking at it from a cost benefit analysis of, EBITDA or adjusted EBITDA being the primary measure. So.
Thanks. So the genesis of us getting this topic was, and I won't say an inconsistency in practice, but differences in how similar, what we might argue are similar debt transactions that happened over time are reflected differently. And that I'm going to change the word investor to users, because our users are normally lenders as opposed to investors, that what users don't like, I'm putting words in Robert and David's mouths, and David, is that they don't know which is happening because there's choices. They would say there are choices. And so the same transaction can get treated differently. And they're interested in when they're going to get their money back. And sort of all the other accounting stuff is less relevant. So I think as we started this journey, it was, could we create consistency by there being, quote unquote, one method, so that there wasn't a disparity among transactions where people need to understand all the nuances. But Robert, David, you guys have any reaction to the dialogue so far? David P?
Yeah, and I know, we discussed this a little bit in the 2 outreach meetings with the surety industry, and kind of the commentary back was, as long, again, common user commentary, but as long as we can make heads or tails of the transactions through disclosures, the methods used are not as important to the user end. It's really the end result that is the piece that people are looking at. So we're using more of a lack of better term, a snapshot in time kind of analysis, and comparative to what the snapshot in time was before. And so as long as we're back to, okay, they've done a debt mod, and this is what the debt looks like today, this is kind of how our analysis goes. So it really wasn't that relevant a topic for the surety industry, even the construction or the non-construction industry people, both.
Thanks, David. David Hoagland?
Yeah, I'd agree with David. I just find the fair value meaningless. If a company's in distress or whatever it might be, right? Like, you're just assigning some, let's call it interest rate, because quite frankly, no one wants to finance it anyway. So there is no market rate. Right. I mean, you can just look at all the transactions happening over the last 5-7 years, right? Like, you're not getting out of these deals. And so what are you really doing? Just assigning some number to it? So if you're just going to assign some number to it, if you want, like, back to Mike's point, just make it a number, right? A big number, and use that if you want to, because no one's really coming up with a market rate, right? That's just an assumption, I think, in my opinion.
Christine?
So excuse me, I agree with you, David. In the case of a TDR, it's just that fair value is just a made up number, because that's not the rate at which the transaction is happening. Because to your point, nobody's loaning this company money at a market rate. And in fact, you've got this related party, their current banker, working out a deal to essentially reduce the rate or eliminate the rate in order to just try to get as much money back as they can. But in the case of an on-market transaction, I think the fair value there does have meaning, because it does represent the market rate of interest at which the transaction presumably is taking place. So I think the problem is commingling the TDR with the market transactions. We have to be really careful, about those two being distinct, because in one case, I think the market, the fair value makes sense, and in the other case, it doesn't.
Thank you. Robert Messer?
One thing I would add, Yeah, the only thing I would add, Christine, is sorry, Jer, is that there's so few homogeneous transactions today that market rates are just kind of hard to come up with in the banking world. But
Thanks for that, David. Robert?
Very, 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 very simplistic. Loans are replayed with cash and cash flow. And I sometimes I hope the accounting doesn't get in the way of being able to estimate what the cash flow will be in the future and compare it to what it was before, because that's the main thing we want to know. And sometimes you really got to rely on the disclosures to understand that. And keeping that where we can see that, I think, is incredibly important, more so than maybe the individual debits and credits.
Thanks, Robert. Doug?
Yeah, just kind of want to go back to the initiation of this conversation, and Jerry, even to your opening comments about the origination of this topic. I know for the 5 years I've been on the PCC, the topic of debt modification and extinguishments has been a topic that we've sort of had on our radar to address. And I know, Jerry, you sort of mentioned in your opening comments about sort of desires for enhanced comparability. But I know, speaking from the prepared perspective, it's I think just as important that we address the sort of underlying complexity. And I think Hillary's comments around the economics are a really important one, and one in which, when I was participating in some of the user outreach early on, was a topic that we were really trying to sort of unveil with the varying banks that we discussed it with. And I think when you start going through the nuances of the 10% cash flow test, and I'm sort of not talking about TDRs and more just on market modification, modifications of debt instruments. I think as we went through with banks, like, hey, you do this 10% test and this is the outcome if it's a modification versus an extinguishment. I think the large sentiment that we were hearing was that banks are more often concerned with the cash flows in the transaction. If you're modifying, it's the additional payments you're making on the front end and then the cash interest you're paying for the remainder of the term. And so regardless of the paper gain or loss you have on the front end with an extinguishment or the heightened interest expense that you then record on the back end versus a modification, you're just sort of readjusting the interest rate and spreading out the interest. Either way, and I think, again, thinking most private companies being an EBITDA-centric business, even going to Christine's comments about, you have this massive gain on the front end that the banks don't pay attention to or pull out of their models, but then you have this heightened interest expense. Well, one, if you're EBITDA-based, generally speaking, that's not going to necessarily hurt you because you're adding interest back anyway. And also, banks are, again, more concerned with cash interest than they are with book interest. And so I think the more that we just sort of unveiled this, it was like, we don't really care how you account for a modification or extinguishment from a bank. Be consistent and disclose it really well on what you're doing, which I think left me in a position of modification or extinguishment, pick one and be consistent with it and disclose it well and go. And so I think when I look at what the working, and I'm not on the working group, but looking at what the working group came up with in terms of, well, if we were going to pick one, sort of understanding, and perhaps there's more user outreach to continue to do, but I do feel like we've heard a lot to this point, is that if it's pick one and be consistent, I do tend to agree that the modification use case is the probably the more preferential use case to apply if you were to give an alternative for a private company. I pause for a second because Hillary's point on, like, well, what do the underlying economics, because at the end of the day, you still want the underlying economics to align. And are there circumstances where extinguishment accounting really does feel like the appropriate accounting based on the underlying economics? And so if I'm sitting where I am today, like, I would love to be in a scenario where it's the alternative that we were, approach as a modification-based model with certain very discrete, concrete examples of where I think we could look at a plain vanilla sort of range and be like, this really feels like it is truly an extinguishment. That would still get you away from the cash flow test. So ideally, no cash flow test. You have a modification-based model that, if we were able to clearly scope and define the circumstances that would really more economically feel like extinguishments, that we carve those in. I'll sort of conclude my comments that I feel like that may be really difficult. I think what we're all, explaining is that the nature of debt modifications take a lot of different shapes, forms, and to clearly scope, like, hey, we're going to give you this alternative for modification accounting, but here's the 1, 2, 3, or 4 circumstances where actually you'll have to apply an extinguishment model. I think we would either have to really scope that discreetly, or we would have to get comfortable that more times than not a modification-based model would still work. And again, lenders are saying truly they don't care, they just want it well disclosed. Then I still think we're getting to an acceptable answer. So those are just kind of where my head's at. I know, again, Chris, in your opening comments, I know I was involved in a lot of user outreach with you and the team early on. I don't know if we've heard any new or differing sentiments in terms of how lenders use this information, financial disclosures, to make different decisions, particularly when they're on the other side of these debt deals. But again, that's kind of where I'm at.
Yeah, just to highlight too, when we were doing private company lender outreach and some of the subsequent ones we've done since, that is the feedback that we've broadly heard, is they don't have a massive preference to any particular model, or at least not a consistent one. It was closer to how Doug described it in terms of being somewhat neutral on the model, but wanting good disclosures and wanting to understand what are the cash outflows going to be after a modification or exchange.
Christine?
But that focus on cash flows, is exactly, I think, what is the right thing that they should be focusing on. And my concern is that under modification accounting, you can end up in a situation where the debt that appears on the balance sheet no longer has any relationship to the amount that's actually owed. And you have a blended interest rate that is neither the interest rate that was the old interest rate or the new interest rate. It's just disconnected because it's a blended interest rate. So, you've got numbers flowing through the income statement that are unrelated to cash flows. You've got a number showing up on the balance sheet that is unrelated to the amount that's actually owed to the creditor. Like I just don't see how we can make the argument that somehow that's conveying the economics of the existing debt. And while it might be enough for lenders to have a lot of disclosure around the arrangement so that they can undo all of the noise that's going through the financial statements, that's one thing. But when it comes to equity claimants and, public companies where folks are trying to forecast information, I just don't know that we're going to get. I'd be surprised if we get the same feedback from equity claimants trying to forecast cash flows. Let me just put it that way.
Doug?
That's helpful context, Christina. And maybe just as a point of clarification to your comments, I guess my perspective isn't that already the case today with modifications where you run the cash flow test, you end up in a modification, you're still having to come up with a new effective interest rate based on payments made to the lender as part of the modification. And so I think what you're describing in terms of the disconnect between cash flows and GAAP interest and balances due is already a case under the current model today. I think we're just suggesting that to getting there, you're eliminating the cash flow test. I just want to make sure I'm understanding the concerns you have with the proposed approach we're saying, because I agree with what you're saying. I just think it's already happening under the current model. That's already a reality, I guess, today. And maybe I'm misunderstanding.
No. I would agree with what you're saying. I wasn't around when modification accounting came about. I would not have supported modification accounting. So I guess what I'm saying is I don't want to take a bad model and use it more. I would rather use it less.
That's helpful clarification. Thank you, Christine.
Hillary?
I agree completely with Christine. So that was the point that I was trying to make as well. And you're absolutely right, Doug. I mean, the model today is written in a way that in almost all circumstances, you end up in a modification answer. And I think just stepping back from it, and I do think that's part of our job, is to think about how do we step back and make sure that investors, users are getting the information they need at a cost that could be reduced, right? And I do think that there are opportunities outside of simply applying the modification guidance to reduce the cost of having to comply with what could be enhanced information as well. So that's where I think there's maybe some additional work that maybe we hadn't thought about in the context of an extinguishment model that maybe still could be done that could help reduce the cost of compliance, but could provide more decision useful information.
Okie dokie. So, would the PCC like the staff to look at this another time and, look at whether this alternative that's been discussed today, is viable, or whether or not a disclosure enhancement or change might work? Or, one of our objectives, if it's too complicated to change, historically what the PCC's role has been is, if it's too complicated for us to do it, we don't do it. That's probably an oversimplification of it, but so feedback, reaction? Michael Chang?
Yeah, I mean, I think it's been, I guess there's shifting floors as we're trying to make a decision. I don't know if we're trying to improve gap overall. I was assuming that we're not going to significantly change debt modification versus extinguishment, or what has been contemplated is kind of set in stone. So I was under the mindset that if we're trying to simplify it, we're trying to actually come up with a practical expedient. Because in practice, outside of TDR, whether it's a bad model or not, I think you do end up in mod accounting. So if there's an off ramp to get there, unless, let's say, upfront fees are significant or greater than 10%, that's essentially a practical expedient to get to the correct accounting. But yes, I guess that makes an assumption that you're not going to change the overall accounting anywhere else. Otherwise, I don't know if we can. I mean, that's kind of hard to figure out. Like, if we're going to change the model to be something significantly different than it is today, and then also try to figure out how to make that easier for private companies at the same time, I think that's tough. I mean, that would make the project a lot more complicated. If we're assuming that the model is not going to change significantly, I think that mod accounting does make sense. And overall, I don't know how users view a gain or a loss. If you get a gain, you're going to end up booking more interest expense in the future, even outside of the TDR. And do we give credit to that gain? If you book a loss, then you're going to have, I guess, a wrong effective rate in the future. How do users view that from a private company space? I get from an economic standpoint, if you issue debt and it's at off market, slightly above or below, that you do have an economic gain or a loss, and that does affect your interest expense. It's just, it's going to take work and cost to get there. Right. And is that something worthwhile for the users of private company financial statements?
Hillary?
Mike, I think your comments are fair, that it does feel like you guys have been looking at this, PCC's been looking at this issue for a while, right? And it does feel like maybe there has been a little bit of a shift in the type of issues that are also coming through to the FASB, asking for a potential change in that accounting, right? Coming through the agenda consultation, coming through the EITF. So I completely, not trying to derail any of the work that's been done by the PCC working group. I think it's really helpful, but I do think it is important to look at it in the context of all of the feedback that we kind of receive from our stakeholders' perspective, and think it's fair, right? That feedback from the agenda consultation will be coming back in front of the board as well. So want to make sure that everyone has the benefit of kind of what those discussions could potentially look like as you guys are thinking about paths going forward.
So would that suggest that us seeing what happens in the agenda consultation process probably will inform whether or not we should be thinking of alternatives for private companies? Is that your opinion?
I think it could be really informative for the PCC with regards to a direction going forward, right? Depending on what path the board goes down, could have very different perspectives for the PCC with regards to what other options are available if that path is not something that they believe is going to be, cost effective from a private company perspective, potentially.
So you're suggesting we shouldn't buy new cars if we're about new tires if we're about to junk the car, right? I've done that before, so wouldn't be the first time I was dumb. So, so is that sort of consensus okay with the group that will allow the FASB to continue on its path and then regroup once we know better what they might do?
That seems to make the most sense to me.
Thanks, Doug. Any?
I don't want to speak for the working. I'm sorry, Jerry. I'm not following protocol. Maybe I don't know if the working group members want to speak up and say if they want to take this back to a working group discussion and sort of align on next steps. But I mean, Hillary's comments notwithstanding, like it certainly wouldn't make sense for us to lean in and come up with all these proposed models or alternatives if the entire model is subject to potential change based on agenda consultation and stuff coming in. So to me, it makes sense to do that. But again, if there's still ways to continue to ideate, it's hard to ideate when you don't know where the boat's heading. But so maybe something the working group may want to deliberate on. Autumn, Mike, I don't know if you guys have thoughts on that, but otherwise it does seem to make sense that we sort of wait to see the direction.
So if anybody disagrees with that conclusion, why don't you speak up? It's harder for me to see your heads nodding on the screen. Okay. Oh, Mr. Chang?
I mean, I don't know what the group thinks. I do think that this has been a consistently raised issue from the private company group and stakeholders, that it is a difficult area. They spend a lot of time. I spend a lot of time on this particular issue. I think that broadly speaking, a lot of people don't quite understand it. So it's tough, but I get it. I mean, if the board is seriously trying to change how this is done, it does not make sense. I mean, yes, I would not buy a new set of tires if I know I'm going to potentially look at a new car. It's just that I don't know how stakeholders are going to view it. If they've been raising this issue, we spent quite a bit of time on it, and we haven't really gotten anywhere.
So I always believe that you can declare a win in almost any situation. So my reaction is we declared a win because the FASB is now going to spend time on the topic. Whether or not they move it forward remains to be seen, but we're going to wait until we hear what they say. So thanks for all your historical feedback, and it's not been lost on anyone.
Yeah, and
Jack?
I think that that's critical, what you just raised. Like, I think it's okay if we've got a great way to communicate what we are doing for the stakeholders, right? Maybe engage. I think we're going to get that question at the Engage conference or in a town hall of what is going on and where did we start and where did we land and what's probably going to happen in the future.
Thank you. Jack?
I would just observe, as mentioned, we have feedback that we have to address from the agenda consultation on a number of related topics. And I think the exercise that and the efforts that we've benefited or the PCC has put forth, along with the working group and the other working group members from the outside, have significantly jump-started that effort and helped the staff and will make that effort go more quickly. And we are very thankful for that.
Thank you. And thanks to Chris and his team that have been working on this. Sue Cosper?
And I might just say, and I agree with Mike, this is a topic that the TIC, for example, has brought up repeatedly over the years. And, certainly we've explored different avenues to try and simplify some of the guidance. And now we're at this crossroads where we've gotten quite a lot of feedback from the agenda consultation. But I think to the extent that the board is able to make some progress on it, I mean, we're only sitting here the beginning of March. Maybe there's something that we can float with the working group or even engage, to get a similar reaction of maybe some ideas that we might have that would benefit that particular vetting to inform the PCC as we go forward.
Great. Thanks for that. Again, declare a win, move on. Way to go for the fences, Chris. Just changing out the team. We're going to introduce a new topic now. We're going to talk about leases. It's a new topic in 26. How about that? Take it away, Jen.
Okay, thank you. Since the December PCC meeting, activities on the PCC Leases Research Project include a Leases Working Group meeting and obtaining additional stakeholder feedback on a few areas that the PCC has been researching. At its January 2026 meeting, the Leases Working Group reached recommendations on whether the PCC should continue research on specific areas that are included in question 1 of your memo. I'm going to quickly summarize those recommendations and then refer you to either the memo or the PCC members who are on the working group for additional details. Starting with the optional single lease classification accounting model, based on feedback from users who did not support such a model and mixed feedback from preparers and practitioners, the working group recommended that an optional single lease classification accounting model no longer be pursued, noting that there's no feasible path forward. Next, the working group recommended that a scope exception for low-value leases should no longer be pursued, noting that the general materiality guidance and GAAP already provides flexibility for private companies to establish capitalization thresholds. That recommendation is consistent with the feedback from a majority of stakeholders who indicated that private companies have established capitalization thresholds in accounting for leases. Therefore, an explicit scope exception for low-value leases is not necessary. The working group recommended that research be continued in the following 3 areas: embedded leases, lease classification criteria, and lease modifications. On embedded leases, specifically, the working group discussed researching a potential private company simplification to forego the recognition and measurement of an embedded lease included in a service arrangement in certain scenarios. Lease classification criteria. Working group members discussed researching a potential simplification in the area of lease classification for certain real estate leases. Lease modifications. Members suggest researching a private company simplification for plain vanilla modifications that would not require reassessment of certain items, for example, the fair value of leased assets, in scenarios in which modifications don't include significant changes. Lastly, there are 2 other areas that the working group recommended to continue researching in combination with the 3 other areas that I just mentioned, rather than as standalone projects. And those 2 areas are weighted average lease disclosures and related party disclosures. So with that, do PCC members have any questions or concerns about the recommendations reached by the Leases Working Group at its January 2026 meeting on the areas that I just went through?
Doug, you have any comments?
Yeah, I mean, I think Jennifer did a really good job of summarizing the work of the working group. It's been a journey, I'll tell you that. I feel like I've been riding the roller coaster. You guys know how passionate I am about lease accounting. I do think we're getting really narrowed in our scope. I think the things that we've agreed not to do further research on, we either got to a quick conclusion that there was just not a feasible way to move forward, or we just thought that the options or alternatives that we had at our disposal weren't actually improvements. The low value lease, it was, well, we could put a $1 threshold on it, but then there's too much at stake. You're going to put a $1 for it. We've seen what's happening in IAS 16 with it have the $5,000 threshold that hasn't been adjusted in 10 years. And now it's already, people are saying it's not really useful anymore. And so again, I think really great discussion would be a way I would characterize the work of the working group. I think we're being honest with ourselves on where there's feasibility and where there's not, and adjusting path accordingly. So I do think the 3 areas of kind of further research, lease modifications, embedded leases, and lease classification for real estate leases are are three areas where I do believe that there's opportunity. I'll speak specifically to embedded leases. We already have examples within 606 that talk about materiality in the context of the contract. I think if we were able to sort of incorporate some of what people are already doing on 606 into 842 for embedded leases, that would be a great path. I don't think personally a quantitative threshold for embedded leases is worthwhile, in the same way that I think we stopped pursuing a quantitative threshold for low value leases. And so personally, I think the further research and potential paths forward would be for a qualitative description of materiality in the context of the contract. I've been preaching the lease classification for real estate leases as being both economically not aligned as well as increasing complexity. I know I specifically sit in a world where we have a lot of real estate leases, so I'm probably biased. And by probably, I mean I'm definitely biased, but I do think there's opportunity there. I know there's been some discussions in previous meetings of, are we taking a step back or going back to 840? I thought the 840 was a good model for real estate leases. I think more times than not, those economically feel like operating leases. And when you start seeing a bunch of finance leases for real estate properties that you're leasing that you're never going to take possession of, that just doesn't make a lot of sense. So, yeah, so those are my broad comments. I think I shared this in the closed session though. We've got some additional outreach we're doing this year. We've got the Engage conference coming up, as well as other liaison events. I would continue to want to probe both preparers and practitioners alike on how comfortable they're feeling with the leases model today. I think that we're getting a growing sentiment that, hey, let's stop changing the guidance. We're now just getting sort of used to it. And then even if it's an optional alternative, that's still another change that we're going to have to flush through. Even if it had a great alternative outcome, but now we have to figure out controls and processes and systems to adopt that. There just may not be a strong desire for change right now. And I think that's something that we need to make sure we're fully understanding. We're still in the early phases of the lease standard, relatively speaking. And so I think with each passing quarter, with each passing year, people are sort of getting used to it and getting comfortable with it. And there's certainly a subset of folks that still find it very challenging. And I can relate to that. I think we've aligned, though, when we were going through the adoption, that we're not going to make the, outside of short-term leases, you've got to put them on the balance sheet, you've got to account for them. I think we're past the point of allowing companies where material to not apply 842. So if that's not going to be an alternative outcome, then I think companies get more used to it over time. And so to me, that's where continued dialogue and feedback will be really impactful for us to be able to understand where do we even need to move. So I would just say for the PCC members, for the embedded lease, for the lease classification, and for lease modifications, the alternatives potentially for plain vanilla leases, if you've got specific questions on those or specific opinions on how we might want to address those, with those three being the ones that we're going to forge a path forward potentially, I think I and the rest of the working group members and the FASB staff helping would love to get any specific thoughts you'd have on how we might approach those three areas. But otherwise, I think just continuing to monitor the sentiments of the community is something that we're going to need to continue to do.
As always, Doug, thanks. Good feedback. Brad?
Yeah, just in terms of his comment, maybe just a little more time for them to get used to it, and not to jump ahead, because I know I've got the survey that we've done next. There is the result there that we find that leases is the one that the private firm CFOs are saying is the most costly or complex to implement. And I guess while I may have expected that result, one of the results that surprised me was on revenue recognition. On revenue recognition, that was actually rated quite low on costly or challenging. And it doesn't seem that long ago that all I heard was complaints about ASC 606 and RevRec. And so I'm a little bit torn here on, I want to do something to help the group that's struggling right now. But I do see this kind of thing in the not too distant past where people have seemingly come to terms and really found it not overly costly once they've done it a couple times. So I agree with where the group is going.
Thanks for that, Brad. Mike Chang?
Thanks. Yeah, no, I agree with the direction of the group. I don't think, even if we came back with any of the changes that are being proposed, that most of the stakeholders at, let's say, Engage, are going to be very happy, because I fundamentally believe that they just don't want to account for leases and just book it as they pay it, or cash basis. I don't know, but meaning they don't want to present value that liability. I do think the proposals in embedded leases, like what you discussed, Doug, and kind of relying on 606 or maybe changing some type of qualitative threshold, that makes sense. I think that's a practical expedient. I do think if you look at the cost of classification and the switch, especially in real estate leases, that 90% test and fair value is costly. I don't know if it gives you the best answer. I think it would improve GAAP. I think 840 had that line correct. And it happens to be less costly to apply. In terms of like related party disclosures, I mean, if people are asking for it, I think the easy fix there is just whatever you're disclosing today for everything else, just do the same thing for related party disclosures. I mean, you already have all the information. I don't know if it'd be that difficult to kind of splice it into two parts. That's what we do at our firm. So.
Thanks, Mike. Other questions or comments? All right, we'll go back with the working group and talk about these things and see where we are. Thanks so much. Now we're going to move the center of the universe to Chapel Hill, North Carolina. I guess this is where Brad is. And he's going to update us on this survey that he and his colleagues have been doing, which, there's not a lot of there's not a lot of research available from private companies. So I think, it's actually quite, you guys should be congratulated for getting this much participation.
All right, thanks, Jerry. So I appreciate being able to spend some time and share this research we've been working on. You can see I'm working with three wonderful people on the project, one of whom even taught our very own Doug Ewell intermediate accounting. So that was the fun connection we made here over the week. But they're Andy Call at USC, Ava Labro, my colleague at North Carolina, and Andrew Sutherland at MIT. I've designed the slides to be fairly self-contained, so there's a fair amount of information on there. I won't touch on every point, however, but feel free to stop me and raise your hand if there's something you want to discuss as we go along. So next slide, what we're doing at a high level is surveying private firm CFOs about the financial information they produce and why they produce it. We divide the survey into two related papers, one focused on managerial accounting, and the one we are discussing today, which examines financial accounting practices. The primary questions of interest in this paper are the accounting basis firms use, who influences that decision, the costs and benefits of GAAP, and the verification choices that firms make. The next slide talks about the motivation for the study. When I joined the PCC, I tried to get up to speed by reading the founding and historical documents. I noted in the first review of the PCC in 2015 that a suggestion was given to conduct a survey to gather input on areas of GAAP that need attention. I asked Mike Minnis if he had a copy of the recent survey, and he said he was not aware of one. I was similarly unaware of anything in the academic literature that might inform this, and so it seemed an opportunity to perform a study that could be informative to both practice and larger research. The next slide talks about other motivation, and that's largely what Jerry talked about. There's a dearth of research on private firm accounting, and that's unfortunate because that's exactly where market forces shape the production of accounting information. They're not required to do it, they opt into it. And so I think we can learn a lot about the trade-offs that exist by studying private firms. Where evidence does exist on private firms, it generally comes from one of two approaches, either third-party data sources, such as banks or the IRS, or researcher-initiated surveys. Each approach has its distinct advantages, but a key benefit of the survey approach is that it allows the researcher to directly tailor questions to the specific outcomes of interest. We're not the first people to use a survey to examine this, but we do think we're quite unique as most surveys are more than 30 years old. And by far the best one that's out there was 20 years ago, and that was done by Christine Bodison. The next slide talks about our survey process.
Is Brad, are you interviewing for a different job?
No. Happy to keep the one I've got. So the survey process we do, we talk to a lot of practitioners about what's of interest, what's costly, what they find useful. We designed a sample instrument. We ran a pilot study. The pilot study was really intended to figure out who was best able to answer our questions. So we sent it to CEOs, CFOs, and controllers. That clarified clearly that CFOs were best positioned to answer the questions that we wanted answered. And so we incorporated the feedback, we identified the target CFOs, and we sent more than 40,000 email invitations. A big surprise, we did not get 40,000 responses to the survey. Rather, we got 542. And so that yields a response rate, which is low, but actually comparable and even higher than many other studies in the space. The median time to completion was 13 minutes, which showed us there had been some thoughtful engagement with the survey. People weren't just clicking through. So go to the next slide. And here's just our methodology. We try to use best practices, including recruitment administration and validation checks. And the questions vary in format, and we'll get to the questions here soon, but many will follow a Likert scale where we use a 0 to 6 point. This structure allows respondents to convey not only direction or agreement, but also the intensity of their views. The next slide tells us who responded. As you can see here, the majority of the respondents came from firms that had between 20 and 500 employees. The CFO requirement clearly concentrated the sample in the small and middle market. These are not sole practitioners, and these are not early stage ventures. The other information about our sample firms were that 65% have bank financing, 20% have a growth investor, half have more than 100 employees, 28% of the CFOs were CPA, and more than 3/4 report significant reliance on technology as part of their accounting operations. So before I move on to questions, let me just stop. Are there any questions about what we're trying to do, who we talked to, anything that you want to discuss before we move on to the questions and what they told us?
Hey, what's the phrase charity donation?
Yeah. When we recruit participants, we're trying, in order to get them to engage, we do a couple things. Is one, we tell them we'll share the results back with them. And that seemed to be important as soon as they actually really expressed an interest in benchmarking their firms, because there is no other data on private firms they can use to benchmark. But the other way is we make a charity donation based on the response rate. And so we give them 5 different charities to select, and based on that response rate, we make a donation to the charities. And so that way is also a way for them to feel incentivized to participate.
Great, thank you for that.
Okay, let's jump to the first question here, which is, which of the following describe the accounting basis of the financial statement your company prepares? This question is taken very closely from Christine's prior survey. And we ask that they select not just one basis, but any that apply. And so we see many firms choosing multiple bases. US GAAP and US GAAP with exceptions are the two most common bases reported among sample firms. We only see 5% that indicate a basis other than the ones that we specifically inquire about. And so although the number of bases appears quite limited, the ways that firm combine the different bases were quite surprising. Across 542 firms, we observed 21 distinct reporting configurations. And so that suggests the private firms, they're not just defaulting to a standard reporting template, but rather they're actively tailoring their reporting to fit their unique circumstances. The next slide shows some information about the persistence of accounting basis. We also asked them 3 years ago, which basis did you use? And what we can see here is that there's high persistence with accounting basis, and that persistence appears to increase with basis complexity. And so where we've seen firms elect to use GAAP before, 93% of them are still using it 3 years later. Where they've used IFRS, 93% are still using it. Very persistent decisions when you're talking about accounting basis. The next slide shows adoption rate. And so what we're going to do here is look at where you didn't use a basis 3 years ago. What's the probability that you've added it to your reporting configuration? What we see is that over that 3-year period we inquire about is that nearly 30% of firms that did not report using GAAP, they've since added GAAP reporting. And so there's a clear movement towards GAAP reporting over time as firms mature. The next question is going to talk about the influences behind companies' decisions to use GAAP. We see right away that external financing clearly matters. Bank lenders show up with a 4.75 rating. I think that's expected. Normally when we ask, why would you use GAAP when you're not required to, the first answer people say is, well, my bank forced me to do it. And so what perhaps is equally surprising then is what shows up second, is that the senior leadership preferences are just as influential as the bank lenders. To that point, we find that nearly 2/3 of our sample firms that do not have bank financing, they still report using GAAP, indicating that GAAP use among private firms is certainly not purely a lender-driven outcome. With regards to the other parties, equity investors, regulators, non-bank lenders, they exert moderate influence. Suppliers, customers, peer firms, and non-senior employees play little to no role in GAAP decision. Any questions on basis? Anything catches you surprised? We would love to get feedback on what questions you still have, what you find interesting, what's surprising. While the survey has been administered, we continue to do CFO interviews. And we like to ask them questions that people obviously bring up as being surprising. So if there's anything that's surprising, I'd love to hear about it. Robert, what?
You have affirmed my greatest fear in life. Financial statements are designed so that people can run their companies better. And I'm not surprised, but I was disappointed that they don't have financial statements to run their company better. They have them to satisfy somebody else. So register that as being expected, but disappointing.
Yeah, I think that is one of the main results to come out of here. Is we often think that GAAP is imposed on people. It's costly to use GAAP, but what we see here is clearly firms electing to use it. And as we'll get into here in a little bit, they'll tell us a little bit about what they're gaining from their decision to electively use GAAP. Doug?
Yeah, I mean, I think you already hit on it, but it was definitely one of the bigger surprises I saw. And I know it's something that we have talked about as a PCC. If you don't like using lease 842 and you're not required to use GAAP, use an alternative metric. So it's very interesting to me that 64% of firms without bank lending are still using GAAP based on the desires of senior leadership. And working for a preparer firm, I do think there is just a broader sentiment from, if I'm a CFO of a company, I think it's GAAP is viewed as the gold standard. And if you're running an accounting shop, even if you're not required to, or even if you don't anticipate taking out debt that would require it or going and doing an IPO, there's still this presumption that, if you're going to be a top tier accounting operation, you're going to adhere to US GAAP. And I think those are discussions and things that we try and influence to some degree of, well, if you don't have to use GAAP because you're not required to by regulation or lending requirements, then what is the sort of opposition to exploring other bases of accounting that would give you a lot of the simplifications that you may be looking for? And I think you may be getting to this, but I feel like there was somewhere in the survey that talked about both companies that have adopted GAAP and have not adopted GAAP, that they're like not a heavy weighting on like the management cost of doing it. I think it was pretty low, I think, in terms of the amount of just resourcing costs to apply GAAP, which I thought was interesting too, because you would think if people are, talking about the complexity of it, that would rate a lot higher on the scale of this is really hard to put into practice, but it didn't feel like from the survey that you guys were getting this pervasive. This is really, really costly, both from a resourcing and expertise perspective to be able to put into place. So a lot of really interesting findings there.
Yeah, thanks, Doug. Yeah, and where they were very concerned about certain costs, we didn't find that it seemed to all aggregate on a single topic, right? Some said it was leases, some said it was, accounting for taxes, and so it didn't seem anything obvious to go target. Of course, the one we've talked about before, leases does show up the highest, but costs do seem a little more moderate than I might have expected going into this from what they told me.
So from in the room, Jackson, you have a comment?
Yeah, I just had a quick question, and I apologize if this is in a detail and I skimmed over it, but I'm assuming those that cited that their senior leadership team was the decisive factor to use US GAAP instead of modified cash or some other accrual-based easier version is because that those would also be in a bucket of not being big enough to be required by the banks. Do you have any insights or thoughts as to why senior leadership was making that request?
Well, and I think the statistic I find most interesting in thinking about that is that when we get to the firms that don't even have bank financing, that they're still electively, 2/3 of them are still electively using GAAP. And so maybe to your point, is that in anticipation that they can then ultimately get a certain bank lender? Maybe, right? And we'll show you here in a little bit about what of the external parties perhaps you're trying to please, and also in terms of what are the internal benefits you're getting. So yeah, I don't have anything that would say it's definitely a size only here.
Yeah, I wasn't thinking necessarily it was to be able to get lending, but rather that I was kind of making the assumptions that anybody that wasn't referring to the banks or the equity markets were because they were small enough size or they had other means that they didn't need bank financing. And I was just curious if you come across anything as to why that might be. My sense is that they're probably trying to, be ready to be flexible if they ever need to get financing or something. But if you come across anything, I'd be curious to hear.
Yeah, the probably the most definitive research I've seen on that actually comes from our co-authors, Andrew Sutherland, who just talks about how non-bank lenders oftentimes don't require financial statements. And so whereas a formal bank agreement may require that, there are ways to access capital without producing GAAP financial statements. Autumn?
Yeah, I just wanted to add my 2 cents, just having been a CFO for a while, and to answer specifically what Jack was talking about. I think in my perspective, it's not necessarily just for bank lenders or for the potential for lending or an IPO, but more so the optionality of it, right? If you think about what the future holds for most any business, it's either lending, it's an exit, it's needing to grow and bring in the right people who, all of whom are going to want to review those financial statements at some point. And so preparing them in accordance with GAAP kind of out of the gate, you're going to avoid having to make some sort of pivot, at some point in the future suddenly. And just having that continuity and using the gold standard, I think is really relevant. And just from my perspective is a big part of the reason why.
Yeah, thanks, Autumn. And that actually puts us right back into the next question.
Well, Brad, as you guys are conducting these interviews, find out whether any of these people are in ESOPs.
Yeah,
I wasn't really meaning that to be a joke, but to the extent that we could find some ESOP, that'd be nice.
Yeah. That wasn't one of the questions. But maybe there's a room for another survey on that. So, yeah, and so let's go to the next slide there. And I think it really brings out a little bit of what Autumn was just saying. We asked the question of, to what extent does your company realize or anticipate realizing the following benefits of providing U.S. GAAP financial statements to external parties? And we certainly see access to lending and lending terms come through. When people do have GAAP, it seems that they do expect benefits with lending. But the next one is a little bit of what Autumn alluded to, is aiding in the preparation for the sale of the business or an IPO. Just being ready with the firm's financials for when the time comes to make an exit. Are your things already in order? Can you move quickly when it's time to strike? And so that was one of the more common benefits that the CFOs pointed to. And then, consistent with earlier patterns, suppliers and customers receive relatively low ratings in terms of perceived benefits from using GAAP. We asked a number of CFOs in interviews, do you ever show your financial statements to your suppliers or customers? It was just very rarely done. They talked about providing some financial information, but certainly not a full set of financial statements. And so they're finding ways to contract without the full set of GAAP financial statements. On the next slide, we're going to ask, to what extent does your company realize the following benefits of providing GAAP financial statements to internal parties? And so we've already thought about the external benefits. Now, what are those things internally that Robert doesn't want to see, but the managers are saying they are benefiting from? And we really see moderate to high support across all of the internal benefits we inquire about, but slightly elevated above the others are benefits relating to internal discipline, with the highest ratings associated with improved budgeting and forecasting. The quote down here is one I like, and not unique, but one of the CFOs noted, from an operational standpoint, GAAP provides sort of the stick to allow for discipline around financial reporting. It's really not uncommon for founders to say, well, let's do it this way one day. The next day, we can do it a little different way. And so it takes all of that out of the equation. It adds clarity, it adds consistency. It allows me as a CFO to say, listen, we just can't do that. And so we would press on the CFOs in our interviews and say, I know you've got bank financing, but let's take it away. Are you still going to use GAAP? And they would come back with these kinds of statements of just, it is adding so much discipline and benchmarking that's useful for us and useful for our business decision making. They didn't see the only benefit being it makes our bank happy. So next slide, we'll move from benefits to costs. And we ask, how concerned are you about the company incurring the following costs of providing U.S. GAAP financial statements to external and internal parties? The response receiving the highest rating is the time and attention required of management and other company personnel However, two things really stood out to me as well from this table. Number one, the average ratings for all of the various cost concerns appeared quite modest. And two, for all of the various costs, more CFOs indicate that they were not concerned than very concerned. And to Doug's point, one might expect this pattern from the firms that are using GAAP, that they say the costs aren't overly restrictive. However, with the 74 firms we survey that don't use GAAP, we see a similar pattern, that they also rate the costs as being relatively moderate with ones and twos in the average rating. And I do want to stop here because this is a result that I think really did quite surprise me. I think we spend a lot of time thinking about the cost of GAAP. And so is there somebody that can, just, maybe a CFO or a investor, let me know what costs are, I guess just your takeaways from this table. I mean, from my perspective, we're trying to create decision useful standards at low cost, and we don't see them all clamoring about a single cost as positive.
In the room, Christine.
So I'm going to step into the breach of silence to ask a different question, Brad.
Yep.
So I just wondered on the benefits to internal parties, what was your thinking in terms of the difference between better allocation of resources and better evaluation of investment opportunities? Because those feel very linked to me, and I'm kind of surprised that the results are so different. So I was just wondering what it is that those two things you think people interpreted those to imply.
Yeah, that's a good question. I think the way we were thinking about it was allocation of resources internally, investment perhaps externally. On the survey, we don't show you some of the question on the managerial side. One of the findings there was that very, very few firms are performing, net present value calculations or capital budgeting. And so, I think what we took away from this a little bit was those evaluations of external investment opportunities they aren't viewing that as significant benefit.
Okay, thank you.
Okay, no other comments. Let's jump back in to the cost question. An interesting drill down shows up on that next slide. When we think about the costs of using GAAP, we do break the sample into firms that either have more than 100 employees or less than 100. And our thought was, are we going to see that the smaller firms are the ones that are really struggling with the costs? Are they the ones that are telling us these costs are more burdensome? We actually don't see that. If anything, we actually see that the larger firms are saying the costs are greater, which may arise from complexity of transaction. But we're not seeing the smallest firms, all say that this is overly costly. Turning to the next slide, we asked who. Oh, go ahead, Doug.
Yeah, just one clarifying question if we go back to the previous slide, that includes all firms that include both those who are using US GAAP as a reporting standard versus those that aren't. Is that correct?
So this would be only the ones that are using GAAP or GAAP with exceptions.
Okay.
I don't remember if we allude to in the paper what the ones not using GAAP say here, but these are the ones that are actually using GAAP.
Yeah, going back to the question you asked on the last slide, that this further breaks out to your question on why is it this way, and why are the cost ratings more tilted towards not concerned or very concerned. I can only think anecdotally it would relate to the fact that I even go back to the way the question's worded. It's like, how concerned are you about your company incurring the following costs of providing US GAAP financial statements to external and internal parties. And I wonder if the not concerned is more geared towards the fact that it's like, well, this is just we've just assumed this is a cost of doing business. Like, I'm not personally concerned about it because these are costs that I just know. Now, if you ask them more specifically, I think you get into this, like what areas of US GAAP are more costly, or that the cost against the perceived value is disparate, then I think they can respond to that. But just on the whole, I think they may just look at it and say, I'm not that concerned about it because I've just assumed that the cost of doing this is just part of the deal. And that would be the reason that I would say, if I was answering that question, like, there's certain standards that don't, like, yeah, it's a lot of cost, but like, am I very concerned about those costs? That would be maybe my anecdotal response to why maybe it's tilted more towards the not concerned than very concerned.
Yep. Okay. That is helpful. Yeah, so on the next slide, we ask, how involved are the following individuals in preparing your company's financial statements? CFOs, the top response, controllers, and other internal personnel heavily involved. We see CEOs and legal professionals play an extremely limited role. And then firms with CPA credentialed CFOs, they rely less on external accounting and legal professionals. And so there is some suggestion that in-house expertise will reduce demand for your external accounting assistance. Next slide. Where we look at verification, and after your company's finished preparing last year's financial statements, which of the following types of verification was performed? What we see is that among GAAP users, 60% obtain a formal audit. Audits are more likely for firms with bank financing, VC or PE backing, for larger firms, CFOs who hold a CPA, and those with greater reliance on technology. Maybe what surprised me was the no assurance reporting. Compilation or none is used by more than 1/4 of the firms that say they use GAAP. Doug.
I'm just going to keep peppering you with questions, man.
I like it.
Hopefully you're ready for it. Similar to the question you asked before about, hey, you're choosing to use US GAAP, but you don't have bank financing. Were there any questions around for the 60% that had formal audits? Were they all because their bank or other party required them, or were there any of these firms that chose to have a formal audit simply because if anyone ever needed that audit, going back to Autumn's comments of flexibility in case something's needed, how many of these firms are picking to have an audit simply because they want to have it just in case?
Yeah, so on that slide, you can see on the bank financing, 64% of the firms with bank financing get an audit, 51% that don't have bank financing get an audit. So not every bank requires an audit, it seems. And many firms that don't use bank financing, they still choose to get an audit. And so there is some variation there. I think these percentages are really unknown in the literature. You know, when I teach in class and people say, well, how many firms choose to get an audit? We just don't have good, benchmarks on this. And so one of the things that we're hoping this provides some benchmarking of the firms that are choosing to do exactly the questions you're asking, Doug. Adam.
Do you have any indications in your data of breakdown by industry?
We don't. We could, and actually we do tabulate that by industry in the managerial accounting paper. We could look at that. If there's something you're interested in there, I'd love to hear it. Because we may end up tabulating that.
Yeah, I was trying to think about the audit requirement. So bank financing, but some industries are more likely to have like third-party boards in the private world. So obviously your nonprofits, your banks, any healthcare, anything serving the community. So that's all going to be really heavy focus on third-party boards. Is going to be more likely to voluntarily get an audit. And I can think of plenty of cases where there's just entities who think they probably have CPAs in management somewhere, and they think audits are the right thing to do. And then I was going to observe the compilations and reviews make a lot of sense to me. If you run a small enterprise and you want financials, and you you're going to go to my CPA firm and say, hey, I want you to give me some financials and help me with some bookkeeping. We're going to give you GAAP. Like that's where we're starting from, right? So,
Yep.
so that strikes me as quite true.
Okay. All right, we just got a few minutes left, so let's move to the next question here, which is really the one that perhaps motivated the study and maybe most of direct interest to current PCC efforts. We ask, which of the following activities has your company engaged in over the last 3 years? And what we do is we come up with 7 different areas after talking to practitioners. We really focus on areas where we have been identified as either particularly complex or that there's uncertain decision usefulness in the accounting that arises from those activities. And so you can see here, leases is the most pervasive across our sample firms. About 2/3 of the firms report leasing. Stock-based compensation is the least prevalent. And I know we talk a lot about that with private firm stock-based compensation, but the prevalence of that is lower than the other activities that we ask about. We do see some clear differences in terms of the pervasiveness based on if you have VC or PE backing. Those firms are more likely to be involved in all of these things. And also, if you're a larger firm, you're more likely to be involved in almost all of these things. And so does seem to be some increasing engagement with these activities based on size and growth aspiration. And then the last result slide that we have here is we're going to ask 2 questions. And if you told us that you were engaged in that activity, then what we're going to ask you is, for that standard, to what extent do you believe that US GAAP provides information that's useful for decision-making purposes? And we'll also ask you, to what extent do you believe that US GAAP is challenging or costly to implement? In the interest of time, I'll just highlight 3 observations I took away. For most topics, CFOs view US GAAP as more useful for decision-making than costly to implement, with leases being the notable exception in our data. Number 2, and the one I alluded to last time when we were discussing leases, RevRec, it receives the highest rating for usefulness, but one of the lowest ratings for being challenging or costly to implement. That was interesting to me, considering all of the complaints I heard about ASC 606 as being so burdensome not too long ago. And number 3, R&D, it has the second lowest usefulness rating, where people frequently say expensing it isn't providing it useful information. That seems to be borne out by the survey. However, implementation costs are even lower. And so as a result, it still appears cost beneficial despite the relatively muted perceived benefit that comes from that accounting for R&D. And so, in conclusion, just a chance to hopefully think about the broader pressures that underlie private firm financial accounting decisions. We spend a lot of our time as researchers studying public firms, but a lot of these decisions are made for them. They're required to use GAAP. They're required to get an audit. And so by coming into the private firm setting, we actually think we can learn quite a bit about the economic trade-offs that surround accounting information. And then I'll just stop there. We've talked about the main points. Are there any other feedback you want to give me? And we're running low on time. If you want to email it to me, I'm happy to take that as well. But just glad you let me present some of what we've been doing, and hopefully you found it useful.
Brad, I think it was awesome. Actually, I think some on this group may enjoy seeing what you guys found in the management accounting part of the study too. If maybe you can refer that on, and it can be some additional reading materials at a future meeting.
Yeah, happy to do that. That's even publicly posted. I can just give you a link.
Cool. Robert?
Yeah, I was just going to ask if this was readily available, and I think you answered that by saying you'll get us a link because I'd love to have a copy of this.
Yeah, this one, that's why I'm so grateful you allowed me to present it, because this one actually we're still really trying to improve it. And the way we do that is going to different places and presenting it, and people tell us what's interesting and what's not. And so this one I expect we'll continue to clean up for probably 1 or 2 months before making it publicly available. But the other part of the survey on managerial accounting, that one is available.
Well, if you would just make this one available when you can, I'd appreciate it.
Yep, of course. And certainly you see the slides here. You can reference those.
Brad, really great. Thank you for asking us and then taking the time to make it for us. So big round of applause. Who is Doug's teacher?
I don't know if it's safe. You know, we've got a lot of people have axe to grind with Doug.
Yeah, I actually messaged him yesterday, Brad. Andy Call, who's the top name on the report, he started his career at UGA. I actually messaged Menace today too and told him he was missing out on participating in that project, Brad, with all those big hitter names on there.
We asked.
Well, we won't hold him against him. You don't get to control who your students are, right?
Can I ask a question?
Christine?
Who was Brad's teacher?
Oh, okay. Christine was my teacher.
Thank you.
And I think it was the very year she wrote her survey on private firms. So there's that connection as well.
Thanks very much. Okay, we're to our last topic of the day, and Jack's going to update us on what's going on at the FASB.
All right, fantastic. So at the FASB, we have a handful of things going on. First of all, our agenda consultation. With regard to agenda consultation, we're working through the 72 issues. As we say, we're probably, 20% of our way through. We've added recently projects on equity method. We've added a project on consolidation and asked staff to do some more work on consolidation. The board has also added, is taking a look at goodwill and a number of other things. So we're moving forward with all those topics. Topics that we have dropped, help me out here, Nellie, have included ARO, some pieces of consolidation, also what else?
Proportionate amortization method didn't pick up.
All right. So, more of the things that we got minimal comments on. So that's the big thing. We continue to work on crypto. We also continue to work on liabilities and equity. And we have a number of PACT meetings coming up over the next few months.
Thanks, Jack. Well, that's all the time we have for today. Thank you guys all for participating, and I'm looking forward to seeing you here in person in June. All the best.
Thanks. Bye, everyone.